come early January, we're going to get a lot of volatility.
As we see global growth picking up outside the U.S., we think we're going to see earnings do better outside the U.S.
Inflation still matters a lot to bond investors.
You just need to see decent economic statistics for that to broaden out.
We actually think the economy could outperform again, maybe even above 3%. We expect more of the same as we enter 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City, from audience worldwide. This is Bloomberg Surveillance. Jonathan and Lisa are off today. I'm joined by Danny Berger in London. I'm Anne-Marie Hordern. Danny, very good morning to you. You and I obviously clearly drew the short straws when it comes to this awkward moment between Christmas and New Year's. And obviously that's completely reflected what's going on in the price action. There really is no Santa Claus rally. It's a Santa pause rally. Everyone is just on pause, waiting for the slew of information they are expecting from 2025, most notably what comes out of Trump 2.0. And you can see that reflected in just this pause we're seeing on this light holiday Friday.
Yeah, so much potentially to come next year. And the setup is maybe an uncomfortable one, Anne-Marie, which is maybe why the end-of-year rally isn't continuing. 2 consecutive days of a decline. The point we've gotten to here is an increasingly top-heavy market. This from Howard Silverblatt of S&P 500. Since the November 5th election, the Mag 7 has accounted for 86% of the S&P 500's gains. In fact, if you were to take them out of the index, the S&P would only be up 0.6%. It's up 4.5% now. So maybe, Anne-Marie, it's difficult to justify buying in these next few days.
Well, that's probably why Torsten Slok has it at one of his main risks. NVIDIA, number 2. NVIDIA earnings disappoint inflated expectations 90% because the entire market seems to be tethered to that. As we've been saying, markets relatively flat this morning, but they are a little bit softer. We did close down flat yesterday. Of course, this is the final Friday of the year, the final Friday of 2025. We do have European shares a little bit higher, not helping U.S. shares, but very light volumes. We have to repeat that today. Euro dollar, 104.21 today. U.S. 10-year yield. There's been a lot of action really in the bond space, especially this month. 10-year yield has risen about 45 basis points so far this month, as the market, of course, is looking at a Fed cutting rates less aggressively than expected. And we have New York crude at $70 a barrel. Coming up this morning on the first hour of surveillance, Marvin Lowe of State Street with stocks on track for their 3rd straight year of gains. Savi Saith of Raymond James on what she calls the bifurcation of the U.S. airline industry. And Dan Ives of Wedbush on his, you guessed it, bullish outlook for tech in 2025. We begin this hour, though, with U.S. futures pointing to a lower open, but markets on track for their 2nd straight year of 20% plus gains. Joining us now is Marvin Lowe, senior strategist at State Street. Marvin, thank you so much for joining us on this Friday, final Friday of 2024. You say in your note that it's not if the fruit has been easy to pick this year, but it will be invariably harder next year. What makes 2025 so difficult?
Well, I mean, certainly the list of unknowns that you kind of listed going into the start of the year is the top of the list. Valuations, concentration in market, and what I really think is a yield story, which still has a lot of layers to unpack. And, ultimately, I say it all the time that the most important number in the world is what that 10-year yield is being priced at. And really kind of the movement that you laid out over the course of the last couple of weeks is saying that there's a lot of uncertainty about that very, very important number.
Well, when it comes to the 10-year yield, you have T. Rowe Price talking about 5%, maybe 6%. At what point does it start to take a bite out of this equity market?
Yeah, I mean, that's a good question. It's ultimately, really, really hard to unpack. One of the things that we get to look at with yields is kind of forward compensation, the risk that bond investors want on top of what they see the inflation outlook to be. That's kind of called the term premium. And really, it's a 10-year term premium that I think is the most important for risk. Right now, it's been the term premium, more compensation for fixed income investors that's been driving this yield higher. I think that we start to really be concerned if we get another 50 basis points of term premium making its way in the market. That's about where it was in the late summer, early fall of 2023, when we had a lot of volatility in the market, and we saw ultimately Treasury and Fed pivot to address that term premium in a lot of ways, but they can't now. The options they have to try to suppress term premiums are much more challenging, given how the Fed has evolved, and really with this new incoming administration and their view on how to issue debt.
Well, right. Even though they're cutting, Marvin, you've seen term premia increase. You've seen yields move higher. So it's going exactly the opposite as one might expect from a Fed cut cycle. Even with that, though, Marvin, this is a market that's priced in less than 2 cuts for next year. Have we not already baked in some of the hawkish pausing pivot from the Fed? Is there not some potential for the downside bias to be in yields?
So the most fascinating thing, I think, over the course of the last couple of weeks is that, yes, we've pivoted quite hawkishly. Generally speaking, when you have a Fed that says that they're not going to cut as much, that they're going to be more hawkish, you would get an impulse that we're more comfortable with their inflation fighting skills. And that term premium should be somewhat contained in that type of environment. We've had the exact opposite. And you and I, Danny, have talked about this offline when I was in the studio, thinking about whether or not a 5.5% 10-year was what we were supposed to think about, because of term premium around the amount of issuance, around really the changes in some of the geopolitical risk in terms of Treasury buyers. And I think that's what's driving all of this, rather than the Fed at this point, which really should unsettle investors a bit, because it does show that there's a decoupling of the normal relationships that we would expect in terms of monetary policy response into the markets.
Marvin, I would love for you to weigh in on this debate that's happening really vigorously right now, whether the Fed has lost control of the bond market. It seems to be what you're hinting at, but the devil's advocate to that would say they haven't lost control. This is a Fed that's building in more optionality, that there is a potential that there are deficits and higher inflation next year. So it's not that they've necessarily lost control of the market. It's just a logical market at this point. What do you think it is?
I mean, I think to a certain degree, 2024 did not do them any justice. The fact that we began the year hawkish, we began the year dovish, went hawkish, went dovish with the 50, and now we're ending the year hawkish, kind of in an environment where the data has surprised them. It's until they come out and say that we understand the economy, which is the exact opposite of what they've done over the course of this year. It's going to be hard for them to kind of influence the animal spirits that drive the long end. At the short end, they still control the market. Really 2-year yields are responding the way you would expect, kind of given these pivots. And that's really been the normal domain for central banks, to really influence the market at the short end. It was only after the GFC, if you will, now kind of a little bit of ancient history, that central banks focused so much on the long end. The U.S. economy has become much more tied to the long end. We're a long duration economy, if you will. And we're seeing how hard it is for them to actually influence the long end when they themselves don't feel comfortable in the data. And really just look at the change in the set, the change in the dots, the expectations over the course of the last year. You see how unsure they are in terms of the economy evolving and how hard it is for the data to interpret. They still don't have a handle on that. And until they do, it's going to be hard for investors to get real comfortable that they can control inflation, that they can control a lot of the animal spirits that drive the long end of the market.
Well, Marvin, when you talk about that uncertainty, well, really isn't that just Donald Trump? You write in your note, the incoming administration will have an outsized impact on market outlook and will be given the benefit of the doubt during the first 100 days. What are you expecting from the Trump administration those first 100 days?
Yeah, I mean, for sure, it's the uncertainty created by this administration. Its policies are something that are, not the normal course of economic models and the economy. I think what we're going to do is get a sense of how they're going to approach fiscal more in the first 100 days. I think 2025 is focused on the budget. It's focused on kind of either making permanent or resuspending a lot of the tax increases that would have come. That would have sunsetted normally, and then just really kind of debt ceiling, as we saw, they really weren't able to get a handle on that. I think that in terms of where yields are going to go, that first 100 days will set what the fiscal approach is going to be. And that's really what's driving a lot of the concern around the bond markets at this point.
What are you expecting in terms of sequencing, though? So you mentioned some fiscal spending. That's likely going to be a tax bill, but that's going to be very challenging to get done almost immediately.
Yep. Yep, for sure. So tariff policy. Just, whether or not tariffs are a means to an end or the end themselves. What we saw during the first administration, the first time the Trump administration sat in these seats, was that they used tariffs as effectively a bully pulpit, a way to get other things that it wanted. If they take that same approach, tariffs probably are not as inflationary as kind of the worst case, where if it's a blanket tariff across the entire world and we're talking somewhere around 15 to 20%, the pass through from an inflation perspective is much more direct and likely much quicker. If we do wind up seeing a little bit of deal making as part of that process, I think that retailers will pass through. I think there is an inflationary impulse, but the long-term impact of it becomes much clearer in terms of it not being something that we need to build into our models permanently, if you will.
Marvin, how much about next year is in general just about being nimble? When you're thinking, how do I set up my portfolio to end the year? What sort of window dressing do I want to do? What does a 2025 portfolio look like? Is it one of just sticking to certain philosophies, to certain positions and convictions you have? Or is this a year where you can't really have convictions?
I think that entering a market like this without convictions is ultimately dangerous. It certainly depends if you're, a very aggressive trader, if you're kind of looking at a hedge fund model where you're looking to leverage from that perspective, you have to be quite nimble. But broadly speaking, from a more traditional investor asset allocation perspective, you need some conviction. You need the conviction either in U.S. stocks, or you need the conviction in terms of globalization, or you need the conviction of asset allocation in general in terms of what your percentage of fixed income is, which is quite low in this market at this point. I think you need that to really anchor you, because we're going to have a lot of volatility. For me, U.S. exceptionalism still works. I think the market concentration that worries a lot of people is there for a reason. These are companies that ultimately have performed, and investors are always willing to pay for growth. And really, this fixed income underweight becomes one of the bigger questions. How much credit, how much sovereign debt, how much interest rate exposure do you want in this market? And that, I think, is probably the most fluid part of the discussion for me.
Marvin, thank you so much for spending some of your holiday week with Danny and myself this morning. Marvin Lowe of State Street, and happy New Year to you as well. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Good morning, Anne-Marie and Danny in London. The Bank of Japan is signaling a rate hike is still possible next month, despite a cautious decision at a recent policy meeting. According to a summary of its December meeting released today, board members expressed both pro-rate hike and wait-and-see views. Factors they're considering include wage trends and the trajectory of the U.S. economy under President-elect Donald Trump. 2024 was a year to forget for France's wealthiest. LVMH CEO Bernard Arnault, L'Oreal heiress Francois Meyer, and Kering CEO Francois Pinault saw about $70 billion erased from their collective wealth this year. This due to weak demand for luxury goods and a pullback by Chinese consumers. Still, some investors are optimistic about the sector, citing the expansion of the middle class in emerging markets and increasing demand for high-end products. And Kim Kardashian is no longer assisting in managing SKKY Partners, the private equity firm she co-founded in 2022. In a securities filing this week, the firm disclosed that the Kardashian is no longer an executive officer. Its website now refers to her as a co-founder and senior operating advisor. She was previously listed as a managing partner. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. We'll have more from Yahira as well, an update in about 30 minutes' time. Up next in the program, next year's airline outlook.
We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. There's still strength there and still some dry powder.
That's coming up next. You're watching Bloomberg Surveillance.
Good morning from London on this holiday shortened week. Your equity markets this morning stacking up like this. It is another weaker session, a second consecutive, led lower by tech in a year that's been very tech heavy. 6,000 above that is where your S&P 500 futures sit. Little change on the euro versus the dollar at 104. Your 10-year yield, that coming under pressure, up 3 basis points despite strong demand for duration yesterday. A very solid 7-year auction. Volumes light across the board, 4.61% on your 10-year yield. NYMEX crude, that sets at $70 a barrel, higher by just under 1%. Under surveillance this morning, next year's airline outlook.
We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. So people are spending on, memories. How do they take trips? We continue to see strength in the consumer in all cohorts. And, they are spending, and we've seen an uptick in holiday spending going into the holiday season. And so, there's still strength there and still some dry powder.
Here's the latest. 2025 will likely be a record-breaking year for the airline industry. According to the International Air Transport Association, global airlines stand to rake in more than $1 trillion, driven by a record 5.3 billion passengers taking to the skies. Savi Sith of Raymond James writes, the economy, and in particular the health of the middle and high-income household consumers, will continue to be the most important factor for the group. And Savi joins us now. Savi, is there any sign of those cohorts slowing down in their airline spend?
Hey, Danny. Yeah, it's been a strong year and for 2024, and what we can see so far is that it's going to continue into 2025. It's been more of a mixed year by airline group, where you have a group that's making good profits and another group that's not, but that's more about internal factors than consumer demand. So the setup for 2025 from a demand perspective looks good.
I want to talk about those two groups, Savi, because on the downside, you have the airlines, as you point out, that have less of a premium offer and don't fly as many international routes. For those airlines, first of all, who are they? And what does recovery look like? Is it possible at this stage?
Yeah, it's a lot of, it's a mixed group, but you have, Southwest in there that's making a small profit this year. You have JetBlue and Spirit and Frontier also kind of making either a small profit or losing money. And so it's been a struggle. But what you've seen since the summer has been this group has really adjusted their capacity. The big difference between this group and the group that's making good money is as you pointed out, just having exposure to premium traffic and international, kind of the strong demand on the international market, but also the amount of capacity that they've added since 2019. And so this is a group that kind of kept taking aircraft during the pandemic. And so given the kind of the level of cost inflation that we've seen, that I think the supply for that group is too high relative to what needs to be passed through in terms of cost. So what you've seen since the summer is an adjustment on capacity growth. And that is making a pretty good setup here into 2025 and probably into 2026 for the group as kind of supply starts to balance back with demand.
Well, this I find so interesting, Savi, because it has really been a period of back and forth. You go through COVID, you go through shutdowns. You don't need the capacity. Then you go through revenge travel, and these airlines can't get enough and need more planes. And now, as you say, they're talking about getting back to equilibrium and maybe not needing all of that capacity. How close are we to equilibrium? You say the outlook is good, but how fragile are we at this moment that something could upset it yet again?
Yeah, I think the issue here is not demand. The issue here is how much costs have gone up. You have seen just mostly labor costs, but costs across the system, including maintenance and aircraft costs, and they've gone up and wiped out about 6 to 8 points of margin that was there in 2019. So it's not about demand. I think the desire to travel is there. It's the price point with which you want to travel. And so I think what we're seeing here is capacity getting right sized to that, to a higher level of fare that's needed to cover costs. And so I think we're getting there. And 2025 promises to be kind of a margin expansion year, especially for those airlines that have struggled. And we probably still need another year into 2026 for many of these airlines to see that recovery back to 2019 margins.
Yeah, because what we've seen this year, Savi, is people still complaining about prices. I mean, we hear it all the time of what it costs to fly internationally. And then you shortly hear that followed with, well, things are so cheap in Europe. Well, things are so cheap in Japan. The yen is so weak. How much of 2025 travel, especially internationally, is just about the strength of the dollar?
Yeah, I mean, I think that's what you've seen in 2024 as well. It's interesting. There is a kind of a tale of two stories here, too, where international supply has actually been much more constrained than domestic U.S. supply. And so the supply issue that you've seen in domestic markets and the margins you've seen in the domestic markets have not been played out in long-haul international. Long-haul international is actually very strong. One, because supply is constrained. You had a lot of wide-body aircraft that have been retired. And the Airbus and Boeing just haven't been able to keep up with the demand to replace that the fleets that have been retired. On top of that, U.S. point of sale particularly has been very strong. I think part of that is kind of a post-pandemic desire to travel, but also the very strong U.S. dollar. And with the strengthening that we've seen recently, I think that's going to continue here into 2025 and is a pretty decent setup for airlines, maybe not necessarily for passenger wallets.
Fair enough. And not us forget what some of that strength is coming from. It's a new administration. So I wonder if you have two things on the side of the airlines, both the strong dollar and M&A's return. Savi, how likely is that? After we saw many attempts, many runs at it get shut down by regulators, where in this industry, what airlines could you potentially see mergers that benefit them? And again, with a more friendly administration?
Yeah, you're exactly right, Danny. You know, you did see 2 or 3 opportunities get dismissed. Alaska, Hawaiian did go through under the current administration. I think, especially given how smaller airlines are struggling, I think we'll see a much more receptiveness to see kind of mergers among, you know, the ULCC group, like a Frontier Spirit or some of the kind of the more private airlines that you see out there. So see opportunity for that in this kind of next administration, which also, puts up a pretty good setup. The other thing I would say with kind of the incoming administration is there seems to be a little bit of kind of regulatory overreach in the current administration as from an airline industry perspective. And we expect to see less of that going forward. And some of the items that are being challenged in courts today, I think will probably come in the favor of airlines as well.
Hey, Savi, before I let you go, we have to talk about some of the drama or maybe attempted drama, lack of drama over the past few days. You had American Air very, very briefly ground some flights, which again did not last long, but still maybe ruined a couple people's holiday travel. You also had Japan Air suffering a cyber attack. In 2025, how much of it is going to be about these airlines right-sizing some of their technology and their offerings?
Yeah, airlines have been doing a lot to invest in technology. It's almost a hamster wheel, although because you are constantly trying to keep up. But there's a lot of investment going into technology, and also, you know, a lot of airlines are moving to the cloud, which is a lot more stable than some of the kind of legacy systems. So I think we will, see a lot of improvement. You'll still see kind of tech issues, but I think airlines are getting better and the technology is getting better about kind of reacting to it. And luckily, the American, tech outage was very, short-lived. A lot of people got delayed, hopefully did misconnect, but at least from a, cancellation point, it was very low. So they recovered very quickly.
Well, hopefully everyone who needs to go back to whatever city that they live in can do so easily after the holidays. Savi, thank you so much. Savi Sith of Raymond James. Coming up, Dan Ives of Wedbush joins on his latest Apple upgrade and his outlook for the tech sector. You're watching Bloomberg Surveillance on this Friday.
Good morning and welcome to Bloomberg Surveillance at 6:30 a.m. right here on the East Coast. It's a shortened holiday week, and you can see that reflected in the markets this morning. We do have futures this morning in the red, second straight session in the red. But of course, Danny, this comes after the S&P 500 up more than 25% this year. A lot of people are starting to calibrate what 2025 has to bring. A lot of people are talking about volatility when it comes to policy out of Washington, D.C. Dates on the horizon. January 10th, we have the Jobs Day, the 15th CPI, and then January 20th is Inauguration Day. And then the Fed meets 10 days later. And how important of what Donald Trump does, and even that first week, potentially gives signs to the FOMC on what's expected, Danny, in 2025.
As you've been saying, Anne-Marie, it is all about sequencing. And as of yet, we don't know what it is because that is still a point that's unknown. So how do you set up a portfolio when 2025 has so many bipolar outcomes? I think one of the remarkable things, and you saw it on that futures board there, Anne-Marie, is that what we thought might work already isn't. And that is something like small caps. That is something like a broadening rally. We thought under Donald Trump that would work. So far, it hasn't.
So far, it hasn't. What we have seen, though, of course, is yields rising. And we just heard from Marvin Lowe talking about how the long end, a lot of that is going to be dictated by policy. The 10-year yield this morning up 3 basis points. Danny, you said even this comes as very strong demand yesterday, Thursday of the holiday week. Strong demand when it came to that debt sale. You do have the 10-year yield now trading at 4.61%. And then the euro. We have seen the weakness in the euro throughout this entire year. We came into the year with euro dollar about 110. Right now, it's sitting at 104. Danny, you're sitting in London right now. How difficult is next year going to be for Europe? France has a new cabinet that they must pass this new budget. Germany is going to be dealing with fresh elections, and all of this as they have a fresh administration to contend with.
It is a political vacuum in Europe and around the world. And perhaps the feeling is most acute in Europe because they don't have the cohesion that they might need in order to combat this. Mario Draghi, one of the big pieces of 2024 was him unveiling this framework for Euro to come together, more investment, more bonds. Individual countries, Anne-Marie, don't even have it together. So what's the ability of Europe to really combat any potential tariffs? As of now, that outlook looks increasingly pessimistic.
Yeah, Europe is going to be a very challenging story for 2025. And that's why a lot of people are saying, look, Jeff, we might get parity when it comes to the euro dollar. Under surveillance this morning, Danny and I have some stories we're watching. South Korea's parliament impeached the acting president, Han Duck-soo, less than 2 weeks after impeaching President Yoon for his brief martial law decree. Han will suspend his duties, and the country's finance minister is now next in line to serve as interim leader. Danny, this is just yet another blow to a government already reeling from Yoon's suspension.
And we should just remind viewers of what the setup looks like now, because they've elevated the finance minister, but he doesn't stop his finance minister job. So he has to be the acting president, now the acting prime minister, because the prime minister also has been impeached, and an acting finance minister. That is nearly an impossible task for one person to do all those three. By the way, in an economy that's facing some issues, sentiment, the latest surveys are extremely low in South Korea. And Anne-Marie, this is the same problem we were just talking about in Europe. They might have more problems coming down the pike if you have Donald Trump trying to put tariffs on a country whose leaders are only acting leaders and having to fill multiple vacancies all at once.
Right. And you look at South Korea and you think actually Germany and France might not look too bad right now. Also, what we're watching this morning, the Azerbaijan Airlines plane that crashed in Kazakhstan during an attempted emergency landing on Christmas Day was damaged by Russian air defense systems. This is according to an Azerbaijan government-backed news website. 38 people were killed in the crash while 29 survived the crash. Absolutely devastating. We should note the cause of the crash still under investigation. But it really, Danny, shows the impact of the fog of war. The aircraft's communication system was paralyzed by the use of electronic warfare systems used by the Russians.
Yeah, it brings back memories of a Malaysia Air flight in 2014 that was also struck down flying over Ukraine and Russian airspace in the middle of the conflict. And Anne-Marie, I was interested in this. Who still flies over Russia? Much of the West is blocked out. Much of Europe is blocked out, not because of safety concerns, but because when sanctions were put on, Russia retaliated by closing its airspace to a lot of these companies. it's fascinating to see that you also have a lot of these airlines complaining about their lack of ability to go over Russian airspace. Air France KLM was saying basically the Chinese are beating us out because they can fly over Russia and cut their flight times down significantly and not have to pay as much in fuel. But incidents like this, I wonder how much it turns to public opinion that a lot of these Western airlines and maybe other ones will decide not to fly over these regions because of their passengers and fear that this sort of thing might happen. It's maybe not just about air fuel costs at this point.
Right, definitely, this fog of war, and we'll bring you any updates we get as that investigation is ongoing. Israel striking multiple targets in Yemen that it said were controlled by Houthis, including military infrastructure and power stations. The attack came as Houthis have been launching attacks on Israel, including ballistic missiles, but Israel has been intercepting most of them. So we have this tit for tat playing out. We also have the Houthis, Danny, really still controlling the Red Sea for much of this year. Interesting stat and a statement from Egypt yesterday. The Red Sea disruptions, of course, this has to do with the consequences of the Houthis' maritime attacks, have cost Egypt at least $7 billion in Suez Canal revenue this year. And we still continue to see this be a headache for vessels that are basically saying we can no longer go through the Red Sea and we have to find different routes to get to our destination.
It's a reminder that this is still happening, that these vessels, that these targeted attacks are still happening in the Red Sea, and a completely different setup that Israel needs to face than some of the Iranian-backed groups in its backyard, Hamas, Hezbollah, ones that they've made significant strides against. Yemen is completely different. Yemen is 1,000 miles away from Israel, and a lot of agencies, experts have said that Israel doesn't have the type of intelligence in Yemen for the Houthis that it does for these other groups. But Amory, I'm really fascinated by this idea. Wall Street Journal article yesterday saying that Israel thinks that it has the chance to really turn diplomacy in its favor in Arab countries. For those that see the Houthis as a thorn in their side, for those like Saudi Arabia that want to curb some of Iran's influence, that these types of actions by Israel help actually coalesce some of these Arab states. Of course, the issue for Israel now, though, is that public opinion, especially in the Middle East of Israel, is at an all-time low.
And also, if they can get a ceasefire hostage agreement through Gaza, we do know that those talks are ongoing. All right, we're going to turn to tech now. Dan Ives of Wedbush raising his Apple price target from $300 to $325, writing, quote, "We believe Apple is heading into a multi-year AI-driven iPhone upgrade cycle that is still being underestimated by the street. Apple's on pace to reach the $4 trillion market cap threshold and be the first member of this exclusive club." I'm so excited that Dan Ives joins us now. Dan, thank you so much for spending part of your holiday shortened week with us here at Bloomberg. So why now? Why lifting the price target now? This awkward week between Christmas and New Year's, and you said, I have a call to make.
Yeah, because the bears, they're in hibernation mode because they can't find AI in the spreadsheets. And look, we're doing the work. What we see across the Asia supply chain, I mean, we're seeing strength not just into December, what I believe is going to be ultimately a record year for Apple, 240 million iPhone units. And that's why, look, this is going to be an AI-driven supercycle that's multi-year. And that's why, look, the haters, they hate it at $2 trillion, despise it at $3 trillion, at $4 trillion, going to be yelling from the top of the mountains.
You write in your note that you estimate roughly 300 million iPhones globally have not upgraded in over 4 years. So do you think this upgrade cycle is going to be led out of necessity because people are just desperate for a new phone? Or is it that AI capability that Apple's starting to introduce?
I think about 60-70% of it is that you've gotten to the point now where that's a pent-up upgrade cycle. It's really unprecedented for Apple. But also remember that install base, that's increased 200 million even over the last few years. So the install base continues to be the golden goose of Cupertino. But the AI-driven piece, it's just starting. That's why it's a get out the popcorn moment, because in our opinion, the consumer AI revolution goes through Cupertino. And I think, look, that's why the bears will talk about valuation like they have for years in Apple. It's about some of the parts, about what AI adds to the story. We think it's $30 to $40 per share.
How hard would it be, though, for the next upgrade cycle, especially if so much is driven now by software updates? The hardware hasn't really changed.
Well, I think that's in iPhone 17. Again, that will be, what we'll be seeing later this year, into 2025. That's actually going to be a hardware-driven, a new form factor that's really going to be AI-driven. So that's why this is almost It's a 1-2 punch. It's 16 into 17. And that's why what makes this unique, it's about the increased services. And ultimately, you have hundreds of apps right now in development that are going to be on top of Apple Intelligence. And that's why the enterprise AI revolution is the godfather of AI, Jensen, NVIDIA. The consumer AI revolution goes through Cupertino. And I think that's why we could see $4 trillion potentially, today or Monday.
One potential difficult spot, or is a difficult spot, is China. Mm-hmm. How are you thinking about China, especially with the fact that Apple needs to partner with a local company to introduce all of this?
Sure. Look, Cook, 10% politician, 90% CEO, right? And no one understands.
He might actually have to be more of a diplomat in 2025 than 10%.
And maybe 30%, 70%. But the point is, look, it's what him and Musk have had to navigate in terms of success in China. But what I love about the cycle, that probably gets announced from the Chinese partner early in 2025. It gets rolled out in April. So the China upgrade cycle in terms of AI coming to China, that's something that happens in April. And this is just the beginning of a multi-year AI cycle that plays out from Apple.
You also talk about Palantir and Salesforce in your note. I recently spoke to Mark Benioff about Agentforce and this new iteration they introduced of Agentforce. And he said it's the most exciting thing he's worked on in his entire career. Is that why you're so excited as well about this?
And for context, Benioff, Mount Rushmore of tech, right? But it speaks to our view. It's 10 p.m. in this AI party that goes to 4 a.m. And behind the velvet ropes, Benioff wanted to see his name's on the list. Now, all of a sudden, he's on the dance floor. Software is let in. Now, already on the dance floor from a use case perspective is the Messi of AI, Palantir. And look, that's one, as I say, the bears can't see AI in the spreadsheets. That's how, they hated Palantir as a teenager earlier this year, despised as a senior citizen living in Delray Beach at 83. But it's just the beginning now of what I view as the software age in AI. Salesforce, Palantir, and I think others like MongoDB.
What names do you think we're going to be talking about next year that were very quiet during 2024? 2024 really was about NVIDIA, Tesla. What do you think will be the names of 2024?
Yeah, I think those continue to lead in terms of my view for large cap tech. I think up 25%, 2025. I think what hasn't been on the radar, it's going to be M&A, software, cybersecurity, because with Khan done at the FTC, that nightmare, whether it's Nightmare on Elm Street, Friday the 13th, is done for tech. Now I think you're going to see a lot of accelerated M&A when it comes to software, when it comes to cybersecurity. And I think that is really is what's going to lead this AI cycle. And I think specifically cybersecurity is an area that I believe could ultimately be one of the biggest outperformers when it comes to tech.
Another tech analyst joined me this week and said the same thing. 2025 is all going to be about cybersecurity. I want to end on Tesla. Overnight, Elon Musk was clashing with a far-right activist who has been close to President-elect Trump, Laura Loomer. And the crux of the argument was about H-1B visas. But this individual is also saying that Musk really isn't MAGA, and yet he's so close to President-elect Trump. Do you think there's a risk there, actually, that he will lose that proximity to power, which you said was one of the best bets of the ages?
Look, it's a bet for the ages. I think that bromance actually gets stronger between Musk and Trump. Because my view is that Trump needs Musk, Musk needs Trump. And whether it's AI, whether it's China, whether it's some of the policies in terms of DOGE, we're going to have these continued dust-ups. So this is going to be a soap opera, I think, for Musk and Trump that continues to play out. But that is going to actually strengthen, and it continues to be for Musk. It's the best bet he ever made on Trump.
Okay, so this is just a flare-up in an episode, not the season finale.
Exactly. View this as just one episode in a 10 to 12-parter on Netflix.
All right. Dan Ives of Wedbush, thank you so much for joining us this Friday. We want to get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hakkas. Hey, Yahira.
Hi, Anne-Marie. Bitcoin's rally is losing steam as traders take profits after its stellar rise this year. And there may be some volatility ahead for the cryptocurrency. According to prime broker Falcon X, a substantial quantity of Bitcoin options contracts expire today. It's one of the biggest such events in the history of digital assets. You could be Jeff Bezos' neighbor in South Florida. A plot of land next to the Amazon founder's properties is in South Florida is on sale for $200 million. The property is about 1.84 acres in size and is located at Indian Creek, a private artificial island in Miami-Dade County. Called the Billionaire Bunker, the island houses properties belonging to Jared Kushner and Ivanka Trump, as well as Tom Brady and Carl Icahn. The $200 million asking price is more than what Bezos paid for any of his 3 properties on the island. And India's former Prime Minister Manmohan Singh died yesterday at the age of 92. Singh was a key figure in India's economic liberalization, serving both as finance minister and prime minister. He is also credited with opening up the economy to foreign investment and increasing its size 7-fold. Singh was respected for his simple lifestyle and commitment to education. That's your Bloomberg Brief. Anne-Marie?
Thank you so much, Yahira. Up next in the program, next year's commodity outlook.
The commodity markets are going, no, growth isn't really very good. The commodity markets are telling you there's not an expectation that there's going to be bigger demand.
What's on the horizon in the commodity space? That's coming up next. You're watching Bloomberg Surveillance this Friday morning on Bloomberg TV.
The Santa rally has come and gone. Good morning. You're with Bloomberg Surveillance this morning to end your holiday week. It is a second consecutive day of declines for this equity market, down 1/3% for your S&P 500 futures, led lower by the Russell 2000. The euro, that's strengthening versus the dollar this morning at 104, but it is yields that move higher. 10-year yield at 4.61%, up by 3 basis points, despite the fact that we had a strong 7-year auction yesterday and weaker labor data, continuing claims at the highest in 3 years. That's still not putting demand into duration this morning. NYMEX crude, that is up nearly 1%, $70.25. Under surveillance this morning, next year's commodity outlook.
The commodity markets are going, no, growth isn't really very good. The commodity markets are telling you there's not an expectation that there's going to be bigger demand.
Here's the latest. Traders looking ahead to next year in the soft commodity market after coffee and cocoa's tear this year. Kona Hake of ED&F Man writing, the outlook for commodities is going to remain sluggish in 2025 due to a potentially strong dollar unless China's stimulus changes demand there. Kona, I'm pleased to say, joins us now. Kona, great to talk to you this morning. So all eyes on China. What is the level? What is the bar of stimulus to change demand, to change your outlook and to have it more robust for this commodity market?
Yeah, I think this whole 2024 so far, we've had various false starts where China would start some stimulus announcements and then they just have a mini rally in anticipation of something big, only to get disappointed because actually the stimulus didn't go far enough. The latest bout of stimulus announcements seem to be focusing on consumer demand and fiscal impacts. And I think this could be a game changer. I think this is where you could start seeing a bit more of a different impact on the global, on the Chinese economy, which so far was very concentrated on infrastructure, export, and that kind of heavy demand type of growth in China, which should in theory have impacted industrial commodities, but didn't have an impact. So now hopefully through consumer demand push, you might see a broad-based growth, which might have a desired impact. But it's, we need to see. We've been disappointed so far.
I was going to say, this has happened quite a few times. You've seen this movie play out before. So is it the specific data you're waiting for, maybe not even the announcements, or once we have the details, the very specific pronouncements of the type of stimulus that's coming, are we off to the races?
No, I think so. Look, so they've had a nice little announcement just before a couple of weeks ago. And I think we need to see more details to come out of that. That then needs to be followed through, and we need to start seeing everything: export data, import data, property sector prices, housing starts, FAI investment. All of that needs to start ticking upwards. Inflation needs to start picking up, but that has been very deflationary in China so far. Once we've seen all of the above, and it's been more than 1 or more than 2 months worth of data tricking upwards, I think that's when you could start seeing some confidence that the Chinese economy is moving the right way in order to encourage the demand that they so badly need.
Kona, it's also been a significant year for soft commodities with weather issues, with various disease issues. But bringing this back around to China, putting these two together, in the last Trump presidency, we saw soft commodities, specifically agricultural, specifically soybeans, really at the front and center of the trade wars. Do you expect a repeat of that this time around?
Yeah, I think that will be a big headwind for the soft commodities and actually commodities generally. I mean, to be honest, my outlook for commodities next year is not terribly bullish because I do think there's going to be a stronger dollar. And the stronger dollar is in turn due to what you were mentioning before, the fact that Donald Trump will become president again and that he has repeated his pledge to maintain tariffs with China, no less. So then you have an issue with, okay, does that then impact China's growth projections? So does that then undo all the stimulus that we were just talking about a second ago? Does that then also cause global trade to fall and the global economy to fall? Because let's face it, when you have tariffs, it does slow demand globally. So that is not necessarily a good base from which you see a launch of commodity prices. So going back to what you're mentioning about tariffs and particularly soft commodities, soybeans got hurt badly. Soybeans in 2024 performed extremely badly, partly because stocks are very ample. Brazil had a big crop, the USA had a big crop, but now the USA faces a situation where you also don't have your biggest market, China, who you're going to be exporting to. So Chinese demand will probably move to Brazilian soybeans, which means the US CBOT, Chicago soybean futures, will have negative implications because they will not have a big market to export to. So that means potentially big carryover stocks for US soybeans, and that's fairly bearish, to be honest. Same kind of thing.
Kona, that's exactly where I wanted to go, if I can jump in, just to the extent that China has already diversified away from the U.S. What is their capability to just turn off the taps and demand and buying from the U.S. and go to places like Brazil at the turn of a dime if they wanted to?
Super easy. And they've been doing that already. They've already diversified their trade. They have to, right? You know, that's their one or two tools, if you like, in which they can negotiate versus the USA. They'll say, okay, fine, you want to put trade barriers on me? I will no longer buy your soybeans. I've shown you that I can move to China. So I think they will use that tactic, and they can, and they have. They could even do that with corn. The USA will already struggle with their agricultural commodity exports because they're going to suffer from a higher, stronger US dollar. So I think that is a negotiation tactic that they can use, and I believe they will. And as you mentioned, it's already proven to be the case, and Brazil will be a net beneficiary of this.
Hey, Kona, less than a minute here. So just quickly, gold, does the rally continue in 2024?
So the dollar is strong, so that's not good for gold, but there's no shortage of I foresee going forward. And I think that just on safe haven demand, I think the gold could really reach new record highs again, which it has been consistently breaking throughout this year. I think there could be more upside because there's so much uncertainty ahead of us in 2025. So I think gold could do well. Softs could do well as well. Yeah. Because of the supply demand balances as well. Because
Kona, great to have you on this morning. Kona Hack there of ED&F. We appreciate your time this morning. Coming up, we're going to catch up with Dan Greenhouse, Ram Casey of Signum, and Drew Petit of Citi. You're watching Bloomberg Surveillance.
Come early January, we're going to get a lot of volatility.
As we see global growth picking up outside the U.S., we think we're going to see earnings do better outside the U.S.
Inflation still matters a lot to bond investors.
You just need to see decent economic statistics for that to broaden out.
We actually think the economy could outperform again, maybe even above 3%. We expect more of the same as we enter 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Morning from New York City, the final Friday of 2024 for our audience worldwide. This is Bloomberg Surveillance. John and Lisa are still off on this shortened holiday week. I'm alongside Danny Berger in London. I'm Anne-Marie Hordern. Danny, thank you so much for joining me this morning. I was all alone yesterday. You and I both drew short straws. And what are we shaping up here? This awkward moment between Christmas and New Year's after really a stellar year on the stock market. We are seeing a pause into what many were hoping for, a Santa Claus rally, with equity futures just off ever so slightly.
Look, there's going to be a lot of people that read into the negativity of the past 2 days and say, what does this mean? It could potentially just be low volumes, window dressing going into the new year. But I think it is significant that the Santa Claus rally has taken a pause, that it's been such a stellar year that maybe it does speak to some holding back. To say tech has been so dominant, this market has been so dominant, there's so many unknowns for 2025. Maybe it's the time we just sit back, take a breather, and try to understand where we might go next.
I love the unknowns for 2025. Torsten Slok put this out earlier in the week. Risk to global markets 2025. The first one, tariffs coming at 90%. Also joining Danny and myself this hour. I know he has a lot of thoughts on what's coming down the pipe in terms of policies of next year. Dan Greenhouse of Solos Alternative Asset Management. Dan, thank you so much for joining us.
Sure, I drew the shortest straw.
No, we're very excited to have you, and you're not concerned at all about this pullback.
No, I mean, listen, the S&P, the high was, as you know, is around 6,100. We're at 6040. It's a little bit of a pullback. Obviously, it's a deeper pullback for the equal weighted index because large cap tech is doing a lot of work. But no, I mean, Danny made the correct point. In the context of the move this year, it's not, I don't think, too concerning.
Absolutely a stellar move. S&P 500 is up more than 25% on the year, but futures are in the red today. It is the final Friday of 2024. We also do have yields, though, pushing a little bit higher today, even though Danny's been talking about the fact that we had a very strong demand yesterday for 7-year notes. We do have yields up 2.8 basis points, 4.61% on the 10-year, and crude up just 0.8%, $7. Crude has been trading in this very narrow range that many are expecting to go into 2025 with. Coming up this hour, Rob Casey of Signum on the challenges facing President-elect Trump, Drew Pettit of Citi on why he expects a more volatile 2025, and highlights from Lisa Abramowitz's interview with JP Morgan CEO Jamie Dimon. But we begin this hour, futures pointing to a lower start, but stocks are on track, as we've been saying, to finish the year up more than 25%. Dan Greenhouse says this: I'm not all that worried. This recent sell-off is telling us anything has materially changed. While certainly did not expect this year-end weakness, given strong seasonals, a healthy economic backdrop, strong company fundamentals, and the incoming administration's business-friendly leaning suggests the bias remains to the upside. Dan's joining us for the hour. Thank you so much for sticking with us. So what do you say, I guess, to people who are saying a lot of this has to do with the fact that people are on the sidelines and they are concerned about the policies that no one really knows how they're going to be implemented or the sequencing of them for the start of next year?
Yeah, there's certainly uncertainty about the policies and the sequencing. That is completely fair. The money on the sideline argument I have rejected on air with you guys before, and I reject again. I just find it impossible to believe that however many years, however many quarters into this very strong, very public equity rally, that there are many investors still sitting on the sideline in any meaningful way. Yes, there's trillions of dollars in money markets, but that's not as... I've rejected
$7 trillion?
Almost $7 trillion now. I've rejected the idea that that's money that's instantly going to transfer into Broadcom. That's not how it works. A lot of that money is there for a reason. It's corporate management. It's people who are in fixed income and are not transferring into equity for any reason. So I don't believe that there are many people sitting in cash. As for the policies, listen, I take a more optimistic view on the tariff side of things, which seems to be what most people are particularly worried about, although buying Greenland might be something of a concern for some as well. On the tariff side of things, listen, the consumer balance sheet is quite healthy. The tariffs are certainly going to affect core goods prices. There's no doubt about it. Although, again, we don't know on what goods, who's getting an exception, et cetera, et cetera. But when you look back at the previous episode of the Trump tariffs, there was not widespread discontent. There was not cats and dogs living together. It was not anarchy. Yes, core goods prices, which had been in a years-long decline, reversed that decline. But headline prices were relatively contained. Consumers in general were not particularly affected by it. And if you have a offsetting move in the currency and perhaps some further downward pressure in oil prices, I think on balance throughout the economy as a whole, it's not necessarily going to be quite as bad as some of the pessimists like to suggest.
So much of 2024, we've seen this concentration in the Mag 7, big tech stocks. Do you think 2025 we can actually see a proper broadening out?
Yeah, well, I mean, listen, I would argue we've had a broadening out. Part of the problem with this conversation is those companies are so big, so much better from a profitability standpoint, both top line and bottom line, relative to the rest of the S&P 500, and their weight in the index makes it nearly impossible for any other company to even register in the conversation, let alone actually in the index. But when you look outside of that, everyone, obviously, recently, home builders have sold off. But before that, home builders were having a good year. The defense companies have recently sold off on DOGE concerns. But before that, we're having a good year. Consumer-related companies, a lot of travel companies, the idea that the consumer is constantly running out of money has been rebutted. Some of the larger energy companies were having decent years. The industrial names that were AI derivative plays, Eaton, Trane Technologies, the HVAC companies, were having very good years. Again, cumulatively, they can stack up, but individually they cannot. And so it's hard for them to get attention when so much of the online chatter and the media chatter revolves around 6, 7, 8, 9, 10 companies. They're just not going to get the same play, but they are having very good years.
Well, I thought this was really weird, Dan. There was a report from Challenger Gray saying that in the year to November, 327 executives, chief executives at U.S. public companies announced they were leaving. That is a record exit in this public market. I mean, we've seen the high-profile examples, the Nikes, the Starbucks, for example. But is something happening on an individual company basis, that there is more churn and something else going on?
I haven't looked into this. My initial guess to your question, Danny, is maybe with the rise in stock prices, management has found itself in an exceedingly secure position that perhaps they weren't some time ago. And a number of the companies you mentioned are having idiosyncratic problems, whether it's Nike or Starbucks, et cetera, et cetera. So a change in management is going to be warranted, if not celebrated. So no, I haven't thought about it very much. But again, with a multi-year rise in stock prices, it's probably a good time to cash out and go skiing.
I like this idea that the way that we find where all these executives have been is to hit the slopes and hit the beaches, and then we'll find our answer for this. Dan, with those valuations that have moved higher, though, SocGen's Edwards, who, again, is a perma bear, but has written extensively on this, saying, look, the last time valuations were like this, which was 2021, which was fine because yields at that point were 1%. This time around is different. And let's be honest, there's been a lot of naysayers saying that high yields at some point is going to come for this equity market, and it hasn't really. If next year is going to be a year of concerns of inflation and deficits, does it finally come for this equity market?
The phrase "at some point" is doing a lot of work in your question. Like, as every strategist of any ilk will say when they're on TV, valuation is not a market timing tool, and it is not. And so I don't know that valuation is suddenly going to be concerned next year. Maybe it will be, but forget my opinion. Let's look at what's just happened. Everyone likes to note correctly that the 10-year yield is up 100 basis points since the Fed began cutting rates, and this is something that we haven't seen before. When the Fed was cutting rates in 2019, the 10-year went down. When the Fed was cutting in 2007, the 10-year went down by as much as 100 basis points. So you are seeing something of a unique development here on that front. However, what people don't like to mention is that both the market cap weighted S&P and the equal weighted S&P are both up over that time frame that the 10-year has gone up by 100 basis points. So I think certainly there is a concern out there about deficits, about yields, et cetera, but what the stock market is telling me thus far, again, forget my opinion, what has happened over the last couple of months, is we have weathered that rise relatively healthily, relatively broadly, and my expectation next year is that's probably going to continue as long as the economy and corporate profits unfold the way that I think I and much of the consensus expects.
The 10-year has been up 45 basis points just this month alone.
Yeah.
You are pointing to a picture where the equity market has been able to weather the storm of rising yields. But how much higher could they go? At some point, does it bite?
Well, listen, I think 5% is not out of the realm of possibility. We saw it once before.
We saw it this year.
Yeah, that's right. It was a bit of a problem for stocks, and might be again. I mean, again, we've risen 100 basis points. The equal weight is up let's say 1 to 2%, which is barely up, but up still, better than the alternative. And if you go up another 40 basis points, let's say, and you get up towards 5%, sure, equities might run into a bit of trouble. But again, the question becomes, in a broader sense, why are yields rising? If they're rising because of inflation concerns, that's a different conversation, which is not what's happening. That's a different conversation than if they're rising for growth expectations, et cetera, which is ultimately going to be positive for profits and, by extension, risk assets.
All right, Dan, you're going to be sticking with us. That's Dan Greenhouse of Solus Alternative Asset Management, joining us for the entire 60 minutes of the 7 o'clock hour. We want to get you an update now on stories elsewhere this morning you should be aware of. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. The turmoil in South Korean politics continues. The country's parliament has voted to impeach acting President Han Duck-soo in the latest blow to a government already reeling after President Yoon Suk-yeol's suspension less than 2 weeks ago for his martial law decree. The impeachment was sparked by Han's refusal to appoint 3 judges to the Constitutional Court, which could finalize President Yoon Suk-yeol's removal from power. Meanwhile, China is launching a probe into beef imports to decide if a surge of overseas shipments have hurt the domestic industry. China's beef producers have struggled with huge losses after local prices plunged to multi-year lows due to oversupply and sluggish consumption. The country's Ministry of Commerce says the investigation will end within 8 months, but could be extended. And Richard Parsons, one of corporate America's most prominent black executives who held top posts at Time Warner and Citigroup, died on Thursday. Parsons previously worked as a lawyer for Nelson Rockefeller and Gerald Ford's White House. Parsons was 76 years old. That's your Bloomberg Brief. Anne-Marie?
Thank you so much, Yahira. Up next on the program, hurdles for the Trump agenda. Under surveillance this morning, hurdles for the Trump agenda.
He's looking for victories that he can demonstrate using executive power and really pretty much end running Congress. Because he, was president for 4 years. He understands even with the Republican trifecta, as he saw last week, you're not always going to get your victories quickly or easily through Congress. So you're going to look to other venues and other uses of presidential power to achieve quick victories.
Here's the latest. President-elect Trump and Congress looking ahead to what they can accomplish in the new year. Rob Casey of Signum Advisors saying a red wave does not mean an easy road ahead for the incoming president. Quote, Trump comes into office on January 20th with significant momentum and a clear agenda. But even a Republican Congress will present a hurdle. No ideologically, but functionally. Rob joins us now. Thank you so much, Rob, for joining us this Friday morning alongside, of course, Dan Greenhouse. Okay, so you say this is going to be challenging, but that was already on display, I think, last week. We had basically 3 iterations of potentially how they could avoid a government shutdown, and they did in the end. But what did the whole saga tell you about how Trump is going to govern, even with these majorities he has in the House and the Senate?
Yeah, first of all, good to be with you both. Happy holidays. It showed us, I think, that when you burn institutions down, when you're running on an anti-institution campaign, then when you come into office, you can't then rely on those institutions to do your bidding, right? It's the Republican House majority is a slim majority, and it's a disunified majority. It's going to be really hard for Trump and especially for Speaker Mike Johnson, if he gets the gavel on January 3rd, to really ensure that they always have a majority vote. This isn't, the days of Nancy Pelosi where every Democrat stayed in line all the time. It's going to be hard to wrangle these folks.
Right. 38 Republicans voted against what Donald Trump wanted to see actually enacted. Well, that whole episode, though, kind of got brushed under the rug. What it said to me was that Speaker Johnson didn't have Trump's buy-in when he went to the floor with that deal that was negotiated with Democrats. Do you think he's able to keep the gavel?
I think he probably is, mostly because I'm not quite sure if there's anybody else who could win a majority vote on January 3rd for Speaker. I would think that the next most obvious pick would be Jim Jordan, who is even further right than Speaker Johnson, even closer to Trump than Speaker Johnson is. But Speaker Johnson has done a very good job, and by and large, he really has had Donald Trump's support. Now, Donald Trump his agenda is going to be difficult to enact. He's certainly swinging for the fences. I think for Mike Johnson as Speaker, it really is, it's about the art of the possible, right? It's not, he can't get everything done that Trump wants to get done, or at least he can't get it done as quickly as Trump would like. So what can he do, and what can he have Trump's buy-in for if he has to negotiate or cooperate a little bit?
I agree with a lot of what you're saying, and I think the average investor isn't aware. We know it's a razor-thin majority right now, a couple of seats. Obviously, some people are departing to leave, to be in the administration, and obviously Matt Gaetz is leaving Congress in general. But I don't think people are aware when the TCJA passed, Republicans had 240 or so seats. It was a much larger majority, and so forget even the ideological differences that the Chip Roy group, if you will, exhibits. Just mathematically, it's going to be really difficult when you can have 1 or 2 or 3 Republicans banding together to not pass no tax on tips or whatever it is that the administration wants to do. Has Republican leadership talked about how to overcome that hurdle?
Well, I think, first of all, they're waiting on a few more seats to be filled. To your point, to have a slightly larger majority after some of these special elections are run and seats are filled. But, you know, I really think it's going to be a question of muddling through, right? And this is kind of the issue. Generally speaking, Congress is not built for, you know, big, fast change. And it's especially true.
By definition.
By definition, exactly. I mean, that's the whole point. And with Republicans having such a small majority, not only in the House, but also in the Senate, and certainly not having the 60-vote majority in the Senate that they would need to unilaterally pass legislation, I mean, it's going to be really challenging. And I think that's one of the reasons why we're not seeing TCJA extension talked about in Q1, right? It's going to take a while, conversation and negotiation within the Republican caucus to get that done over, you know, Q3, Q4.
Every congressman and every congresswoman basically becomes king or queen of the Hill, in essence. I think of one person in particular, Congressman Lawler of New York, who basically is saying, I'm not going to vote for anything unless salt's included, because he also wants to run for governor of New York. I think, wink, wink. I think he pretty much said that in his Christmas, Hanukkah message. So when you have individuals that are so tethered to specific issues, is there, in your mind, 5 issues that must be included in TCJA in order for it to meet the demands of all these different vying factions?
Well, I think when push comes to shove, the worst case for Republicans is we will see a clean TCJA extension. So if we get to Q4 and there hasn't been, you know, an agreement reached.
So base case.
Base case, we get TCJA extension, clean, skinny. I mean, that's essentially what just happened with the budget negotiations and, you know, last week, is that there was all of this discussion of, you know, riders and add-ons and this kind of major Christmas tree bill with a bunch of stuff, you know, individuals' preferences and priorities. None of that was in the final bill. There was some farm aid, et cetera, extension of the farm bill, but mostly it's like the lowest common denominator is the clean, skinny package. And given that TCJA for individuals ends end of 2025, I think that the absolute necessity in our base case is that Republicans will pass an extension. Now, the question is, what in addition do they pass? Is it no tax on tips, no tax on overtime, SALT, you know, extension or relief? I think all of that will be part of the broader negotiation, but much harder to get done.
For the same reasons we just discussed, I don't know how you do any of the other things. There's no built-in constituency in Congress. It's not as if we've spent years building up an argument for no tax on tips or whatever it might be. So to your point about the TCJA clean extension being the base case, I think that's almost your only outcome. It's your bear, it's your base, and it's your bull outcome. Because I just don't see how, when you have 2 Republicans that want one thing and 4 Republicans that are against that, but for something else, I just don't know how you come to any sort of an agreement on anything, especially if you're going to try to get 2 reconciliation bills in this year. So I think that's your base, your bull, and your bear outcome. I don't think there's any conversation at all.
Yeah, I totally agree. Congressman Lawler and others will certainly be talking about SALT. And I think that there's a small chance we could see a doubling of the SALT cap from 10 to 20,000.
Sure, the marriage penalty.
Yeah, but other than that, I think it is fair to say that what is the skinny bill, you know, the simple answer is probably going to be the most likely answer throughout this next Congress, because the bottom line is, I totally agree. Once you try and bring a few folks on one side, you're going to lose folks on the other side. And so it winds up just being, again, the art of the possible. What can Mike Johnson convince President-elect Donald Trump is good enough, is enough of his agenda to get through? And what can he convince his caucus to vote for?
Okay, I want to talk to you about the fight that was looming yesterday on Twitter. I'm not sure if you saw it. It was between Laura Loomer and actually a ton of other people. I know, Dan, you also saw it. So basically, Musk and the far right, at the end of the day, are arguing over immigration and H-1B visas. Where do you think Trump comes down on this issue?
Well, I think Trump, his focus first and foremost is on the border. So it's not to say he hasn't thought about the H-1B question, the skilled immigrants coming question. It is not his first priority, right? He wants to secure the southern border. He wants
not his, but the priority of many people he's putting in the administration.
Yeah, exactly. I totally agree. And frankly, the priority of his base that got him elected not once but twice. And so I don't think he has. On the H-1B question, it's not going to be his priority. It's clear that it's Ramaswamy and Musk want to talk about it. And it is, again, another example of a rift we're seeing in this kind of bigger tent Republican Party.
Yeah, so for the viewers that may not be as online as we are, just to clarify, there is this debate going on among what we call the right that wants to restrict immigration in a broad sense, and what has been known now as the tech right, the Elon Musk world, that agrees in general with the idea of restricting immigration writ large, but also wants to increase the availability of these H-1B visas that provide for the quote-unquote skilled immigration. And those two worlds are clashing for some reason. It happened over the weekend. I guess Vivek Ramaswamy got involved. I would agree that I don't know that the President-elect Trump has spent too much time thinking about the nuances of this, but he has spoken in the past about the need for skilled immigration. He wants to make it possible for those people to come here. I think while this is a fun online conversation, I think the skilled immigration argument is going to win out, because you do have Musk sitting in such an important position next to the president. You have had the president discussing the need for skilled immigration, and it does provide for the masses something of a bifurcation, so you don't look as restrictive by saying, listen, we just want to close the border, to your point, but we also want the skilled people to come here. Is that not where this settles out?
Well, I think it is probably the hope for Donald Trump and Elon Musk, et cetera, right? That's kind of your perfect mix. It's your best. We're going to close the border, but we're also going to allow the best and the brightest into the country to propel our economy forward. The issue is that's just not how the far right sees it, right? And so I actually think that changes to the H-1B program are going to be harder, or I should say easier said than done. Right? It makes sense to many of us. It makes sense in the context of the economy as it sits today. Certainly, you can have both, right? You can close the border. You can also allow the most skilled in, that there's no sort of internal disagreement there. But the issue is, I think, MAGA Republicans, it's not what they want. Right? And while Trump doesn't have to get reelected in 4 years, he can't get reelected in 4 years. House Republicans have to get reelected in 2 years. Senate Republicans have to get reelected 2, 4, and 6 years from now. So they have to answer to the MAGA base.
Right. And you made a great point. Musk is definitely not in this far right Laura Loomer camp. He's battling them, for those that maybe are just kicking up online on exactly what happened overnight. So let's talk about January. We have 60 seconds. Sequencing: immigration, tax policy, tariffs. 1, 2, 3.
I think so. We'll get the first reconciliation package will be immigration and energy. I think the second sort of big conversation, although we're already having it now here, is tariffs. It's probably Europe early, China, early, but most importantly backloaded and very high on and targeted on specific sectors. And then the tax question is going to be 2H. And the bottom line is it's because the Republicans don't have the package around which they can form a majority today.
Rob Casey, thank you so much for joining us this morning, and happy holidays and happy 2025. Rob Casey of Signum Global Advisors. Coming up on the program, highlights from Lisa's interview with Jamie Dimon last month at APEC in Peru. You're watching Bloomberg Surveillance. Happy Friday. Good morning. Welcome to Bloomberg Surveillance. I'm Anna Marie. John and Lisa are still off on this shortened holiday week. Santa Claus rally, no more. We do have a pause when it comes to U.S. equity futures. This is the second straight session where we are in the red, although we should note trading volumes are very light, and we've had an absolutely stunning year when it comes to this bull market. S&P 500 is up more than 25% this year, but you can see across the board, S&P 500 futures down 0.3%, alongside the NASDAQ 100 futures and Russell down 0.4% as well. Across asset this morning, a lot of moves, and there has been, of course, over the course of the month in the bond space. 10-year yield at 4.6% this morning, up 2 basis points. Danny was talking about how we had this such strong demand yesterday for that debt sale, 7-year auction. I believe that was the final one of 2024. Lisa will keep you in the loop on all the debt auctions you need to be looking out for 2025. But the 10-year yield has risen 45 basis points so far this month, about 100 since the first Fed cut. Dan Greenhouse, who's our guest host this hour, has been talking about the fact that it's okay. Equities have been able to rally with this level of yields. And then when it comes to foreign exchange this morning, euro dollar sitting around 104. Of course, the euro is going to have a very challenging time at the start of 2025. France has a new cabinet. They need to pass a budget. Germany's going to have fresh elections. All of this coupled with this uncertainty of these two political crises in the two biggest economies in Europe is the fact that they are going to have to contend with Trump 2.0, whether it's the Fed, whether it's financial markets, or whether or not it's the European Union. They're waiting to see what Trump and the second iteration of his administration brings, especially when it comes to tariffs. Under surveillance this morning, the Bitcoin rally taking a breather with investors opting to take profits ahead of what could be a volatile stretch ahead. The crypto market is bracing for a number of option contracts to expire today with warnings of a, quote, choppy market to come. Isn't that the point, Dan Greenhouse, of Bitcoin, a choppy market? Although we have to say, this has been on a tear since Trump's election. I think he actually tweeted, "You're welcome."
Well, if you're a Bitcoin investor and you own anything adjacent to Bitcoin, yeah, you should probably be.
Are you in this space?
Solus owns a couple of Bitcoin adjacent securities. I don't think we invest in Bitcoin specifically, but we do own some stuff that benefits from mining, et cetera, et cetera. Listen, I think it's hard to view this as anything other than a risk-on asset right now. I know there are a lot of people that treat it as a store of value.
They're talking about maybe a crypto strategic reserve.
Yeah, Rob Casey talked about easier said than done. I think that might be the case for this as well. But those are the types of suggestions that you get from the incoming administration, which help drive the price from 60,000 to 100,000. And I know Bloomberg has a story up this morning talking about the rally fizzling. I wouldn't call being down a few $1,000 from 100,000 as fizzling. The investor enthusiasm for Bitcoin is just as strong as it was yesterday, and you have any number of people out there, Mike Novogratz, et cetera, saying it's going to 200, 250, 300,000 in fairly short order. If this level of momentum continues, then that certainly could be the case.
Also under surveillance this morning, Russian President Vladimir Putin casting doubts on the future of natural gas flows from the country to the rest of Europe. The move sending benchmark futures higher. The loss of Russian gas would force Eurozone countries to rely more on alternative sources, with the U.S. already ramping up LNG shipments to the continent. What's interesting about this is that, well, we do see the price action right now of Putin's comments, but actually Europe was already talking about the fact that they might need to buy more from the United States. And Ursula von der Leyen, after President Trump was elected, said, well, maybe we can blunt some of these tariffs by buying more U.S. LNG. Is this something you foresee happening, potentially how policy could meet demand of the market?
Yeah, I think so. Europe in general has to figure this out because they are, for lack of a better word, subservient to this market and this supplier. And I think it's the great irony of the last couple of years that in an effort to diversify itself away, it ended up becoming susceptible to this type of market development. Say what you will about the United States and our slower adoption of EVs, et cetera, we are in an enviable position relative to Europe with respect to energy demand and sourcing. And I think, again, Europe is going to have to figure this out over the next couple of years. What's going on in Germany is related to this. What's going on in Europe more generally is related to this. And it's a story that's going to unfold over the next 3 and 5 years. And I pray, just as a citizen of Earth, that they make the correct decisions over these few years.
Okay, also under surveillance this morning, Christmas Day, bringing ratings joy to the NFL's Netflix debut as well as the NBA. The NBA's 5-game lineup averaged over 5 million viewers throughout the day, marking a 5-year high, and Netflix drew an average audience of more than 24 million for its 2-game slate, setting a record for NFL streaming. A lot of this, I think, had to do with the fact that Beyonce was there. I talked about this stat yesterday, and I think it's interesting. Netflix agreed to pay $150 million to broadcast 2 NFL games on Christmas. That is $50 million more than producing a season of Game of Thrones for 2 games. This came from The Athletic. Did you tune in?
I watched. Of course I did. Beyonce's at halftime. Of course I'm tuning in. Listen, Netflix is $925 a share. They are doing a lot right. And I think
stock is up 90% this year.
It doesn't get included in the Mag 7, but it's one of those names that's Mag 7 adjacent, we'll call it. Listen, the NFL is the dominant live sports, live entertainment viewing option across linear, across streaming, et cetera, et cetera. To put 24 million in context, everyone loves Succession. Something like 1 or 2 or 3 million people watch Succession. It's just, the NFL, as everybody knows, dwarfs everything else from a rating standpoint. And so if you're Netflix and you're trying to diversify away and get into video games, if you're trying to get into live sports, you saw this with Mike Tyson, Jake Paul, the NFL is the best and the brightest, so to speak, and it's absolutely, from a viewership standpoint, the right decision. Although I will push back and say a lot of it did not have to do with Beyonce. 24 million people watched. It spiked up to 27 million during the halftime show.
Yeah, it spiked during Beyonce.
It did. Other people viewed in for Beyonce. I was one of those. Sure, I like a good. What are the Beyonce people called?
Beehive.
Oh,
are you part of the Beehive?
No, I'm not part of the Beehive.
I think maybe you are.
I don't think I'm the target
halftime
audience.
show. One thing is for sure, there was that technical debacle when it came to the Jake Paul, Mike Tyson, and I think Netflix was
None of that yesterday.
None of that yesterday. Netflix was able to prove it. And maybe this means actually these broadcasting rights are just going to go higher and higher because people are tuning in for them. All right, JP Morgan CEO Jamie Dimon says the next Trump administration will inherit, quote, the most complicated geopolitical landscape since World War II. Dimon sat down with our own Lisa Abramowitz at the APEC CEO Summit in Peru earlier this month and talked about his expectations.
You had a big sea change that took place in that vote the other day, and some people were prepared and some weren't prepared. But I think the most important thing is whoever had been elected, and this is my belief, they are entering and going to be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best. I think people try to help get through this. It could be a difficult thing with a lot of unknowns and uncertainties. And so policy is going to matter. And, of course, who runs the government will be determinative there.
President-elect Donald Trump sends a message to you that he respects you greatly, but you will not be part of the Trump administration as a Treasury Secretary, if that were something that were interesting to you.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. And I'm not about ready to start.
I want to start by also talking about the response in markets in the U.S., which has very much been, this is going to be a pro-growth shock with companies that are going to be investing much more, deploying cash, aggressive in terms of U.S. expansion. Have you seen any signs that that's truly the case?
Well, yeah. You've already seen, the markets have responded quite well. And, I think America needs a growth strategy, so I literally applaud that. I think collaboration between government and business is the way to have growth. They've already spoken about a deregulatory environment. I want to point out, I'm not talking about just getting rid of regulations, but the regulatory environment in most countries has become stifling. And in a lot of countries, including Peru, it's why you're growing maybe at 2.5%, not 4 or 5. In America, it's why we've been growing at 2% for 20 years and maybe not 3. So I do think it's a reasonable thing to have that kind of reform. And that reform has to go deeper than just regulations, which can unleash capital and investment and banking and stuff like that. It's got to be permitting and all the related things that come with that, where people, you were just mentioning a mine that someone bought that could do rare earths in the United States. It's 10 years. They haven't gotten their permits yet. I mean, it's a shame, and we're doing this to ourselves, and it's a mistake. So I applaud any government that says, I'm going to make government more efficient. And I think inefficient government is one of the reasons that people are frustrated. That why you have some populism, because they may blame, they may look at big companies, but they also know their government isn't spending their money wisely.
Dimon also spoke to Lisa about the ability for the incoming Trump administration to fast-track M&A and loosen banking regulations.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later I said 1 in, 5 out. I think they're going to do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit. And so and you could have kept the banks equally safe, but had them do more credit. And so, like, to just give an example, the average bank in America, I think the number is, used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulation that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. Yeah, it's a huge disadvantage. So yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JP Morgan.
There's also a question, whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so yeah, absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen, and one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies, you're going to be losing people. You want to start working a common culture and common technology, you can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressive at acquisitions and deployment of capital, and they should.
One of the highlights of the year, that was Lisa speaking with JP Morgan CEO Jamie Dimon. Dan, they're talking about M&A there, and a lot of people are talking about the fact that M&A has been actually sitting on the sidelines, and there's a ton of pent-up demand, and the regulatory environment looks a little bit more friendly now.
The regulatory environment can't get worse, I guess. So
the JetBlue CEO also said that to us in terms of antitrust. Couldn't get worse than where it was.
Yeah, that's right. Ultimately, what matters for M&A activity is if the economy remains strong, balance sheets remain healthy among the acquirers, then that's ultimately going to be the biggest tailwind. Obviously, the regulatory change in environment, Lena Khan, Jonathan Cantor, et cetera, not being there is going to be something of a tailwind for sure. And so in general, I think you should certainly expect an uptick. We've already seen numerous headlines of companies talking about potential mergers and acquisitions or acquiring targets. You've seen indications what's going on with it's not exactly related to this, but what's going on with Comcast and Warner Brothers, where they are in some cases spinning out or segregating their linear business in the hope of maybe doing a merger, is probably partially related to this, the environment being a little more friendly. I think that's going to continue for most of the year. I think the one pushback I've had on this topic, or the main pushback I've had on this topic, is the idea that somehow the incoming administration is a traditional Republican administration in thinking about mergers and acquisitions. And I think there is a strain of thought in the J.D. Vance camp, in the J.D. Vance part of the Republican Party, that thinks that mergers and acquisitions are not exactly the great benefit that traditional Republicans have thought, that consumers have been harmed, workers have been harmed to a larger degree than perhaps previously thought.
Right, and it comes to big tech. J.D. Vance actually said Lena Khan was one of the few people in the Biden world doing a very good job. Yeah, so definitely something and a good caveat to point out. All right, let's get you an update on other stories we're watching this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Azerbaijan Airlines plane was damaged by Russian air defense systems before it crashed in Kazakhstan. That's according to a government-backed news site. The plane was struck while approaching Russian-controlled Chechnya, according to the report, which said the aircraft's communication system was completely paralyzed. Meanwhile, South Korean companies linked to Netflix's Squid Game series fell in today's trading after a disappointing season 2 debut. The survival thriller was a massive success when it first dropped in 2021 and topped Netflix's most watched titles on every continent. The new season, released yesterday, received poor reviews. Meanwhile, in sports, Liverpool is marching closer to the Premier League title after beating Leicester City 3-1. Superstar Mo Salah scored the game's final goal, bringing Liverpool's lead over second-place Chelsea to 7 points. Chelsea, for its part, dropped a key Boxing Day match to 8th place Fulham, and Nottingham Forest continues its stunning season with a win over Tottenham, giving them a 1-point edge over Arsenal for 3rd place in the league. That's your Bloomberg Brief. Anne-Marie?
And poor Danny was at that Chelsea match yesterday. Danny, we're very sorry for your loss. Up next in the program, bracing for the new year.
This year, though, everyone's kind of been looking for that opportunity to buy. Maybe we get the Santa rally, but I think come early January, we're going to get a lot of volatility.
Doesn't look like we're getting that Santa rally this morning. Equity futures are softer. That's coming up next. You're watching Bloomberg Surveillance. Good Friday morning, final Friday trading day of 2024. And what a 2024 it has been. S&P 500 has been up more than 25% this year. Although it doesn't look like the market's going to get its Santa Claus rally that it was hoping for, we do have equities pulling back ahead of the open in about 90 minutes time. S&P 500 futures down 0.3% this morning. Euro dollar at 104. We've been talking a lot about the political crises that have inflicting Europe, whether it's Germany, whether it's France, and how this lack of cohesion as they are dealing with an incoming Trump administration. A lot of analysts are calling for parity in 2025 when it comes to euro dollar, which came into the year around 110. Bonds this morning, we do have the 10-year yield at 4.6%, up 2 basis points. This comes after strong demand yesterday from the 7-year note. And New York crude this morning, $70.35. Very narrow trading rate over the course of months when it comes to crude. A lot of this has to do with supply and demand picture, and a lot of people are expecting that to also continue into the new year. Under surveillance this morning, bracing for the new year.
This year, though, everyone's kind of been looking for that opportunity to buy. We had the dip post-FOMC. I think people bought that dip. I think people are going to have to digest what does it look like in the new year with President Trump, with Musk. Maybe we get the Santa rally, but I think come early January, we're going to get a lot of volatility.
Here's the latest. S&P 500, NASDAQ 100, and Russell 2000 all looking to finish the year with double-digit gains, leaving many investors anticipating next year's market move. Drew Pettit of Citi writing, quote, expect a more volatile phase of the bull market next year. Overall, a lot of good news is priced in, meaning Q4 reporting and first 100-day policy pushes could create bouts of volatility. Drew joins us now, and of course, Dan Greenhouse is still with us. So, Drew, what are you expecting that first 100 days of the Trump administration, since everyone coming on this program says we have to wait for the policies?
I think that's the beauty of the setup. I don't know what to expect, and I'm not really sure if markets really know what to expect. I think that creates some volatility. Look, in conversations with clients, we've heard a lot about immigration fears. We're worried about tariffs. And then on the other side, you have the deregulation angle. So when we talk about a bull market entering a volatile phase, yeah, we think fundamentals are strong, but all these little drips of news here and there probably bounce you around a little bit. And you probably see a little bit more aggressive rotation between sectors and size and style as well.
Drew, do you feel like investors you talk to are actively changing portfolio allocation because of the immigration concern? I know everyone's concerned about it and everyone's talking about it and worried about the potential for inflation, but is anyone actually doing anything about it?
I don't think so. To be honest with you, I don't think anyone's even making a whole lot of aggressive deregulation trades. You really saw the banks in some of these sectors, even like energy as well, like pop post-election, but you've seen that rally fade. So they really haven't bought into the long-term trade there. And on immigration, same thing. Everyone's trying to figure out what might hurt the consumer, even on tariffs, too. There's a lot of talk, everyone's sharpening their pencils. So when we finally get the news event, whether it's good or bad, I think that's when you'll start to see the trade. And that plays into why we think we'll see some volatility in the first half of next year.
You know, you might not be seeing a lot of trading around the regulation side of things, but isn't it fair to say if you look at the defense stocks, Lockheed, General Dynamics, et cetera, that you have seen a DOGE-related trade going on?
I think there's just a lot of concern about government spending in general. You can honestly say that's shown up in bond markets probably more than it's shown up in equity markets. You know, to us, I would say, yes, you've seen some of that. That's completely fair. We do still think there's some risk there on the industrial side and capital goods. But honestly, could it be a rate thing? Could it be a debt thing? Could it be DOGE? I think kind of, you know, pick your narrative.
So I guess when you put it all together, the question for investors going into next year is we've had two really strong years for the S&P 500, 20+% back-to-back. For the equal weight index, a more moderate but still good back-to-back year, call it 11, 12% back-to-back. I sense a lot of hesitancy going into next year. I can't be too bullish because we've had such strong years. Obviously, there's volatility and uncertainty about the administration. But the 2 years gives a lot of people pause. Well, we just can't see a third good year again. Is that a fair way to characterize how people are thinking about it? And do you agree with that?
I actually don't agree with that. I think investors might be saying that. They might be talking about that on the fringes. But when you look at the data, the price action alone, look at margin debt, look at TRF volumes as a percent of the tape, look at even some of the other sentiment gauges, including our Levkovich index composite, I think markets are still really euphoric. Where we get a little bit concerned on this front is everyone's talking about their concerns, but you're not trading them. So they're telling you one thing, doing another. So everyone might come on, talk about volatility. They might talk about being concerned. They might talk about having no real corrections in 2024. But at the end of the day, they're buying equities. They're bullish.
Drew, thank you so much for joining us, and Happy New Year to you. Drew Pettit of Citi, Dan Greenhouse of Solus. Thank you for joining us this hour. Some final thoughts with you. You know, your number one advice for 2025 after being in this market in 2024?
Have a friend with you in the New York City subway. I think that's my number one advice. Now, outside of that, on the investing side of things,
I mean, in financial markets,
yes,
very funny.
Sometimes you have to clarify with me. But listen, I admittedly take an optimistic view of the landscape. I get that. There are things about which one should be concerned. My pushback is there's always things about which one should be concerned. And while I'm admittedly taking an optimistic view of things entering the next year, I base that on data and reality. We saw tariffs once, weren't terrible. We saw a change in administration, wasn't terrible. And my bias is to the upside as a result of that.
Well, thank you for spending your shortened holiday week, Friday, with us, the final Friday of the year. Coming up in the program, Anna Rothbun of CBiz and Kate McShane of Goldman Sachs. This is Bloomberg.
Come early January, we're going to get a lot of volatility.
As we see global growth picking up outside the U.S., we think we're going to see earnings do better outside the U.S.
Inflation still matters a lot to bond investors.
You just need to see decent economic statistics for that to broaden out.
We actually think the economy could outperform again, maybe even above 3%. We expect more of the same as we enter 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning and welcome to the final Friday of 2024. For our audience worldwide, I am Anne-Marie Hordern alongside Danny Berger, who's joining me in London today. Danny, very good morning to you. The Santa rally is not shaping up to be one. We are hitting a pause after yesterday's muted session, although it is a very shortened holiday week and we cannot negate what was a stellar 2024 when it comes to these equity markets. S&P 500 up more than 25%. But the year is drawing to close, and right now it's drawing to close on a red note.
Yeah, It is, but it hasn't really changed opinions. You were just talking to Dan Greenhouse saying, look, I have an optimistic view. The outlook for this equity market is a strong one, with calls as high as 7,000 to end the year. Where you get less consistency on the calls, Anne-Marie, and I think this is really fascinating, is the bond market. You have very different views. You have a bearish view coming from Deutsche Bank that 4.7% is their target for 10-year yields. Then you have someone who's more positive, like Morgan Stanley, 3.6%. So much is going to depend on policy, but it is a torn bond market despite the cohesion of the equity market. Both can't be true at the same time, but to be fair, it has been the enthusiasm of the equity market that's called this economy right for the most part of 2024.
Right, and Dan Greenhouse has been talking about the fact that even though we've seen even just this month alone, 45 basis points higher in yields, the fact of the matter is equity markets have been able to deal with it. It is point number 8 on Torsten Slok's risks to the global markets in 2025. U.S. 10-year interest rates move above 5% before mid-year at 40%. Some of his top risks, tariffs coming in at 90%. NVIDIA earnings disappointing, another 90%. U.S. economy reaccelerates and animal spirits coming back, 85%. Danny, you know what is last on the probability list? And it has a 0% chance, a U.S. recession.
Because how many people called for a U.S. recession at this point last year? In 2023, to end the year, we're saying a U.S. recession is coming. We're going to get something like 6 cuts from the Fed. All of those were upended. Bond investors were really, really punished for those that put that trade on. We've learned that betting against the American consumer and this American economy has been a losing bet. For now, those fears of economic weakness, they've been turned elsewhere to China and Europe.
Right, and how much is that U.S. exceptionalism going to withstand the test of 2025, especially when we have all of these unknowns? Okay, so sort of we're shaping up when it comes to the equity market this morning. As Danny and I have been talking about, S&P 500 futures, it's been a stellar year, but futures are down nearly 0.4%. Euro dollar this morning, one to certainly watch in 2025, as many are calling for potential parity as we see paralysis in the core of Europe and France and Germany. 10-year yield up 2 basis points, 4.6%. And New York crude, NYMEX crude, $70.30 this morning. Coming up in the program, the 8 o'clock hour of surveillance, Anna Rathbun of CBiz with the Santa Claus rally taking a breather. Kate McShane of Goldman Sachs, why she sees upside for retail stocks next year. And Chuck Lieberman of Advisors Capital Management on inflation risks in 2025. We begin this hour with stocks on pause heading into the final days of the year after a blistering rally for equities in 2024. The S&P 500 up more than 26% year to date. Anna Rathbun of CBiz seeing upside ahead next year, writing, assets will go where there is higher relative value. From this perspective, we are still constructive on U.S. equities and even tech, despite the high valuations. Anna joins us now. Anna, thank you so much for your time this morning. So with all these uncertainties going into 2025, what are you most keenly looking for?
Good morning. Santa Rally may not be here, but maybe Santa's telling us that we've had a lot of returns in the last 2 years. And from that perspective, it's difficult to imagine a 2025 where we're going to continue to see this type of return. So going into 2025, we are still, as you read, constructive on tech because we see that it's not just a want to have in terms of AI and other developments, it's a need to have. Especially for corporations that are developing AI, if they're not on top of it, they're going to lose out. And from that perspective, I think we're going to continue to see R&D. We're going to continue to see new developments. And we're going to continue to see that AI development being filtering down to other sectors and potentially seeing something that is, increasing productivity levels more than we may have anticipated in the past. And that's going to catch up with us pretty quickly.
Anna, great to see you this morning. For investors who just buy a simple index fund, they've got a lot of NVIDIA in there. This is a point that Torsten Slok makes that Anne-Marie was mentioning, that the big have gotten bigger. He says it's a risk, that investors are underappreciating, that they essentially have a portfolio leveraged to NVIDIA. Is he right?
That is always a risk. Concentration risk is something that if you're an index investor, you really can't help. But at the same time, we have been talking about concentration risk for I don't know, 2 years. And if you weren't in the index, you would have missed out. There are a lot of active managers that have been underweight those names that have missed out. So I think that despite the fact that NVIDIA is a big holding, there may be a reason why. Maybe investors telling us that, okay, their exposure to AI and their advancement in AI may be something that the valuation can actually justify.
I was going to say also, Anna, if you had bet on valuations that they were too high and used that as a market timing tool, you also would have missed out massively. We still constantly hear the calls, though, that they can't sustain themselves, even as you see yields going higher, that's going to be an issue, that at some point valuations need to come back to earth. Is it different this time around? When we're talking about AI and the future promise of earnings, do we need to recalibrate just what valuations can and should look like?
Whenever people say, it's different this time, it never is. So I'm not going to join that. I'm not going to join that camp. But at the same time, certain things are different. For example, when internet came out, it didn't exist right before. And we had to readjust. I think it's the same for AI. In terms of valuations, I think this is why you have to diversify in your portfolio, especially because we're capital allocators. We don't bet on a single sector. We don't bet on a single stock. We make sure that we're diversified because at the end of the day, market timing is possible and valuing tool. So while we recognize that there are risks in valuation, we actually don't try to time the market with it.
Anna, I love in your note that you call inflation the Fed's favorite child when it comes to, their dual mandate. Were they burned by the transitory episode? Is that what you think is really driving a lot of what we saw at this month's Fed meeting?
Yeah, I think that 2 years ago now, I think the Fed was using data and judgment, right? And they're saying, okay, this is transitory because this data movement that we're seeing may be short term. And then they did get burned. And I think they're overcorrecting now. And they're responding to short-term data movements. I mean, all it took was, 2 or 3 months of CPI data coming in a little hotter than expected. And we're talking about a little hotter for them to say, okay, now inflation is front and center, despite the fact that we've been telling you for the last 6 months that it has been employment that has become front and center. So I think that going into 2025, even if we have a little bit of weakness continuing in the labor market, they're going to look at inflation and say, okay, this is still our priority, even if we see labor market starting to deteriorate.
You mentioned there the reaction of the Fed to every data point. This is something Mohamed El-Erian argued earlier in the week in an FT column, essentially saying that they've become hyper dependent on the data, and it's a problem for both the market and the economy. Anna, is it a problem?
I do believe so. First of all, data don't move in a smooth way. Data are by nature volatile, which means that their perception of how the economy is doing, and therefore potentially communication and monetary policy, it's going to be volatile. So for the markets, that's very confusing. For the economy, if you're data dependent, that means you're relying on lagging information. And so you have to accept the fact that, and there's no getting around this, you have to accept the fact that if there's no judgment involved and you're constantly looking at backward-looking data, then you might actually be late. And it's the same mistake that the Fed made when inflation was going up, maybe the same mistake the Fed makes when inflation is going down.
Anna, thank you so much for your time this morning, and Happy New Year to you and your family. Anna Rothbun of CBiz. We thank you for your Friday morning contribution. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. Israel struck multiple targets in Yemen that it said were controlled by the Houthis, including military infrastructure and power stations. The strikes led to at least 6 deaths and 40 injuries. The operation was in response to repeated Houthi attacks against Israel, capped off by a ballistic missile strike on a Tel Aviv playground. The Houthis have pledged to keep attacking Israel as long as the war continues in Gaza. Meanwhile, pregnant women infected with COVID-19 were found to have a higher risk of severe complications, including emergency C-sections and even death. According to a UCLA study, 14% of infants born to mothers who tested positive for COVID-19 showed signs of developmental problems. Researchers caution that larger studies are needed to confirm the link. And in sports, the Seahawks keeping their playoff hopes alive after beating the Chicago Bears in Thursday Night Football. Seattle held the Bears to just 3 points and intercepted a late pass from Bears QB Caleb Williams to seal the win. Seattle needs the LA Rams to lose to keep their playoff hopes alive. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. And Yahira will be back with us for an update in about 30 minutes' time. Coming up in the program, Kate McShane of Goldman Sachs and her top retail picks for 2025. That's coming up next. You're watching Bloomberg Surveillance.
Well, it's the Friday after Christmas and before New Year's, and if you are trading today, hats off to you. You're maybe one of few, but it is an equity market that is on track for its second consecutive day of declines. This time around, it is being led by small caps. Your S&P 500 future session down by about 0.33% after a very strong 2024 and optimism for 25. Euro versus the dollar, that's at 104 this morning. Stronger euro by about 0.1%. Your 10-year yield, that comes under pressure, higher by 1.6 basis points. We're just under 4.6%. It was a strong duration bid yesterday, a 7-year auction that went on without a hitch despite the fears of a deficit coming for 2025. How much longer do the strong auctions keep this bond market chugging along? NYMEX crude, that's trading at $70.23, just under 1% of a rally this morning. When it comes to the holiday season, Bloomberg Economics reporting a slight drop in holiday shopping this season compared to a year ago. Retailers noting a bifurcated consumer with demand staying solid from middle to high income consumers. Pleased to say that Kate McShane of Goldman Sachs joins us now. Kate, great to catch up with you this morning. Look, this holiday season is no exception. It is the bifurcated consumer that we keep hearing over and over again. Is there any reason to expect that we might hear anything different in 2025?
Good morning. Well, we do think that we could see slight improvement in the lower income consumer in 2025. What we're looking at, which is our discretionary cash flow analysis that we put out 4 times a year, is measuring how much cash flow the consumer will have going into 2025. And overall, the consumer's cash flow should increase about 5.2%. in 2025. That is being led by the higher income demographic, which is expected to grow about 5.5%. But the lowest income demographic discretionary cash flow is expected to grow 4%. And so there is healthy growth there. I think disposable income is moderating a little bit for the consumer, but you are seeing some easing of financial obligations with an easing interest rate, of course, and then seeing dissipation of inflation.
What consumer companies benefit from that, Kate? Because one of the fascinating trends of this year has been companies that you usually associate with lower income consumers, that of Walmart, being able to get greater market share from middle and upper. So if the lower starts to participate more, is it the same companies? Is it a broader rally that encapsulates more types of consumer companies?
It's a great question. I think for sure Walmart has definitely capitalized on being able to address a wider array of consumers, both lower, middle, and higher end, as you mentioned. The ones that still cater to the lowest income consumer, which are the discounters like Dollar General and Dollar Tree, have actually been impacted by the fact that that lowest income consumer has been troubled or dealing with such high inflation, with most of their dollars going towards consumables versus discretionary or just more choiceful decisions even within consumables. So if the lower income consumer is a little bit healthier in 2025, you could see slightly better trends at the discounters who cater to that lower income consumer, which is around $30,000 income and below.
For the Walmarts, for the Costcos that have been winning market share, Kate, in times past, it's been used as a signal of a not a good thing, that there's a downturn. People are more concerned about their wallet. They're more concerned about savings. That hasn't been said this time this year. Why is this time different? Why is it not a signal that we should take that things are deteriorating among the consumer?
Well, the success of Walmart and Costco, I think, is much more a testament to execution than anything really with what's going on in the macroeconomic environment. Walmart, if we can take as an example of what's happening there, from an execution standpoint, they have really benefited from improving their general merchandise category, their overall store experience, their omni-channel, being able to both be an online and brick and mortar retailer. And given all of those things, including fulfillment and Walmart Plus, which is their subscription service, they've been able to cater to this much wider swath of consumers, which has resulted in quite a bit of growth. They also are very focused on price, of course, which in an inflationary environment did attract quite a few consumers to them as well. But Walmart's success, I think, can be more attributed to the fact that they've been investing in their business, in technology, in building out their fulfillment optionality for consumers, and it's been more execution.
The building out of the online, Kate, I'm really interested in this for a different reason, maybe. Because online shopping has been just so popular. It has since COVID, and it's taken off. The figures for this holiday season show really robust growth from Adobe Analytics and how much people are buying online. But with that comes things like returns. And for these companies, that's a problem because not only do they often have to pay for the return, a lot of times they get these products back, you can't sell them again, there's something wrong with them. All of that would eat into margins. Kate, is that a problem for companies? Do companies need to think of a kind of strategy for dealing with especially margins in an increasingly online shopping world?
Well, I think that it is the benefit of being a brick and mortar retailer, or being a true omni-channel retailer. I joke around that I am a retail analyst, so we do believe in the existence of stores and the need for stores. But when you think about it, the physical retail is really important. Think about this holiday season, for instance. There were 5 less shopping days this holiday season than there was last year. And everybody was talking about what a big rush there would be because there were 5 less shopping days. That is going to be able to be fulfilled by stores that can stay open to 10 or 11 o'clock on Christmas Eve. So that physical real estate is really important. And we're seeing that with regards to the optionality it gives the consumer too, whether it's buying that product or returning that product. So again, if you were to look at some of the big box stores like Walmart and Target that have thousands of points of distribution through their store network, they are able to get to the customer online, but that customer can get it by picking it up in the store. They can get it delivered out to their car, or they can get it delivered to their house. And that's been a real game changer for anyone in brick and mortar retail that's been able to improve that customer service and in terms of the optionality they're providing for that consumer. And it goes for returns as well.
Kate, another possible big headwind that a lot of these retailers have coming into 2025, and it's no surprise to anyone because this is something we all talked about heading into this election. I think I know where I'm going, is supply chains and the risk that it's going to get a lot more expensive, not just from China, but where other companies have migrated to South America, for example, to Mexico. How nimble and ready are some of these retailers if tariffs are put on in their ability to move more locally?
Yes. So we have seen with our retailers some change in the supply chain since tariffs were last implemented by the Trump administration in 2018, 2019. You have seen production taken out of certain countries and moved to others. There are going to be categories that aren't quite as nimble or can't move as readily as other categories. Consumer electronics is the one that comes to mind that still very much is imported from China. But for the most retailers that we cover, you have seen some diversification in that supply chain over the last 6 years. So there is some reduced risk than maybe there was 6 years ago. But I think inevitably it is going to raise costs for those that are producing products out of China or importing products from China. And you will see some price increases as a result, just like we did in 2018.
Well, along with those costs, you have seen just some strikes, some labor discontent over this holiday season. Starbucks and Amazon, not countrywide, again, and just in some specific instances, you have seen strikes ongoing. Are wages also going to be a stress for these companies? Is this sort of discontent among the workers likely to get more widespread in the coming year?
Well, it's hard to say exactly. I mean, I think we have seen, at least in retail, some moderation of the wage increase that we saw since COVID. So you're still seeing wages increase for sure, but it's increasing at a more normalized rate, I would say, between 2 and 4%, versus what we've actually seen the last few years where wages were increasing a little bit faster than that. And I think if inflation is dissipating, there could be, a less pressure that wages would have to increase more because wages right now are increasing faster than prices. And so our modeling in most of our retail models are anticipating wage increases at a more normalized rate around 3%.
Ahead of that, though, there's a very specific deadline that they're going to have to contend with, and that is the deadline for the dock workers to reach an agreement, the longshoremen and the companies that own it. What do inventories look like ahead of that? Have some of these companies been trying to front run any possible disruption?
Yes. So we do believe some of the companies have tried to front run the disruption. We did see that with the threat of the strike a couple of months ago as well, where some companies brought in inventory earlier, just in case the strike was prolonged. You've also seen divergence of containers to go to other ports, changes like that, as well as bringing in that inventory earlier. But inventory levels overall, honestly, if you were to look at what everyone reported at the end of their third quarter, didn't look highly elevated to us. Inventory growth is still in line or slightly below sales growth.
Hey, Kate, just to wrap things up, just quickly here, less than a minute. We saw goods be popular during COVID. That's gone to services. Do you expect that to stay the trend, or could we have a rotation back into goods?
We're really thinking we're going to have a rotation back into goods in 2025. That is our call in the hard lines, broad lines space for a couple of reasons. One, we just talked about the health of the consumer, which we do think will remain strong in 25, just given the employment backdrop. Two, it has been a couple of years of negative growth in most discretionary categories. Again, consumer electronics, certain apparel categories, certain home goods categories. And so we do think, lapping those easier compares, the pent-up demand will result in more discretionary growth in 2025.
Fair enough. Hey, Kate, gonna have to jump in there. Thank you so much for joining us this morning. Kate McShane of Goldman Sachs. You're watching Bloomberg TV.
Good morning. Welcome to Bloomberg Surveillance. I'm Anna Maherdern alongside Danny Berger in London. What you're contending with today is the final Friday of 2024, the awkward moment after Christmas, ahead of New Year. Many people were hoping for a Santa rally, but we have hit pause. We have futures ever so light this morning. S&P 500 futures are down nearly, there they are, 0.4%. This comes after a muted session yesterday. Danny, though, 2024 has been a stunning year for this equity market, especially in the tech space.
Yeah, so many people got it wrong. So many people heading into 2024 said, it was going to be small caps that take it away. There's going to be a broadening rally. There's going to be a recession. Risk isn't going to do as well. That is not at all what happened. We get some of those calls coming into 2025 that there will be broadening, that it won't just be tech, that small caps will do well. Well, guess what's happened over the past couple months since the election? The Russell 2000 is flat, and it has been tech that has led the way.
And when it comes to what's going on in the bond space, though, even though we have seen rising yields, as Dan Greenhouse has been talking about, the equity market has been able to deal with rising yields. You have a 10-year now just below 4.6%. We are hovering. We were higher than that across the yield space yesterday and today. Danny, you've been talking about that demand we saw in the 7-year notes yesterday. I keep going back to the risks for next year. Risk to global markets in 2025 from Torsten Slok. Number 8 on his list, U.S. 10-year interest rates move above 5% mid-year. 40% are putting a probability on that.
Yeah, well, he also sees the potential for hikes next year. Right. And look, you could look at the setup and maybe scratch your head as to why we're not seeing more of a bid into this bond market. A good auction yesterday for duration, not to mention labor market data that wasn't the strongest, continuous claims rising to the most in 3 years. You could make the argument that there's some labor market weakness that regardless of where inflation goes, that will force the Fed's hand to cut. The fact that we're not getting it, Anne-Marie, to your point, just speaks to the term premium that's being built in. That speaks to the concern not just about inflation, but of higher deficits and what that means in terms of how much yield that investors are going to demand in 2025 on the long end of this curve.
Higher deficits and potentially tariffs, and what this means in terms of a reinflationary environment. Number 1 on Torsten's list, tariffs coming. 90% of individuals expect that. Well, I think they should. President of the United States-elect Donald Trump is already trying to negotiate them. And what we are seeing across in the FX space, Danny, euro dollar, a little bit of strength on euro, but really when you look at the entire year, the story has been weak euro, weak European Union, no growth in Europe, political paralysis in Germany and France, and just U.S. exceptionalism.
I was going to say so much about the weak euro story has been about the strength of the dollar. That problem's abroad, that problem's politically in Germany, in France, South Korea, Romania, you name it. Problems abroad make the dollar more attractive. The difference this time around, though, is that Europe would probably welcome a weaker euro. They need it for their growth picture. The S&P cutting 50 basis points, a surprise cut to that extent, because they were concerned about the strength of the franc. How much of 2025 is going to be about central banks playing defense? They're going to be trying to move their currencies in a way to stimulate growth, because when it comes to fiscal governments, Anne-Marie, they don't have the cohesion in order to combat some of the things that might be coming from the U.S., like tariffs.
Right, and the U.S. dollar on track for the best year since 2015. I think that's my chart of the year. All right, we're 1 hour away from the cash open. Here's your morning movers with Yahira Hackes. Hey, Yahira, what do you got for us?
Hi, Anne-Marie. We start with EV battery maker SES AI getting quite the boost in the pre-market, up more than 70%. But since Monday, this stock is up some 500%. And while I can't find any real catalyst for this move, this is a company that could benefit in the future from the transition to EV. Still, the stock is down some 80% from its all-time high reached back in November 2021. Next up, we have Tesla. Those shares are down about 0.8%, and it continues its fall from yesterday. And there was a report yesterday from Hertz basically saying that the car rental company is so desperate to shed its Tesla inventory that it's telling customers if they want to keep their rentals. Or this could be a classic case of profit taking, with the stock up about 80% year to date. And finally, we have Apple. We are on watch for Apple to hit the $4 trillion market cap milestone. The stock is down just slightly, but the number to watch out for to hit that huge milestone is around $264. And Anne-Marie, you had that great conversation with Dan Ives earlier today, and he says that the rest of the street is underestimating Apple's AI potential and its ability to sell iPhones because of it. But at the same time, you have strategists over at BTIG warning that history suggests near-term weakness for the stock. So we'll see if today is the day that it hits that milestone.
Yahira, thank you so much. Yeah, Dan Ives talking earlier about Apple raising the price target $325 per share. It was at $300. So he's certainly bullish going into 2025 on this potential upgrade cycle. Turning now to the Fed, markets expecting fewer rate cuts next year with questions about the impacts of President-elect Donald Trump's policies. Joanne Bianco of Bond Blocks writes, quote, "We do not see much data to justify further rate cuts in an environment of strong growth and sticky inflation, especially if the potentially expansionary policies of the new administration are factored in. Nonetheless, while the stronger economy may mean rates stay higher for longer, this would also be supportive of many areas of fixed income." Joanne joins us now. Joanne, one thing I wanted to ask you, really jumping off of what Torsten Slok and this note he put out about global risk, is he's talking about this potential for rate interest rate rises in 2025. 40%. A lot of people are saying, you know what, the Fed might not be on pause. They might actually have to raise rates driven by the fiscal policies out of Washington, D.C. What do you make of that?
Well, we certainly think that rates have to stay higher for longer. We're totally back to the higher for longer language. And, it's just been a remarkable move in the 10 years since the Fed started cutting rates. The 10-year is almost 100 basis points higher in yield. So the market doesn't like, the fact that they've been cutting rates. And, but the thing is that this means that long duration assets can continue to be very volatile, but yet there's still a lot of areas of fixed income that you can take advantage of in the strong economy. And the number one area in our view is credit.
The number one is credit, but spreads have been so tight, Joanne. I mean, how much tighter can this market really get? At what point does that just make you feel uncomfortable?
Well, there are reasons why spreads are tight. They're tight because we do have the strong economy, because we do have companies that have basically since the pandemic have been focused on shoring up their balance sheets in terms of refinancing their debt. And, so you don't have the same kind of excess building in credit markets that you've seen predated like past down cycles. So we're just in a better quality environment, is particularly in the U.S. high yield market. There's more double Bs than there's ever been. The triple B corporate market is very healthy as well. So investors can take advantage of that. Another thing is that spreads, yes, they're at the tight end of the range, but they can persist. History has definitely shown that spreads can persist at tight levels under the right conditions for even years at a time.
Okay, this I find really interesting, the makeup of this credit market, how much more healthy it is, Joanne, specifically because credit markets used to be this thing that are the canary in the coal mine, that when spread starts to blow out, it means something bad for the economy and it's a real big risk. Is it different this time around? Is the credit market maybe not as much of an overall signal as it used to be just because of the makeup of the companies in it now?
Well, it's the focus by these companies on shoring up their balance sheets, on refinancing their debt, on not taking on too many risky expansionary CapEx types of projects. So there are a lot of reasons why, the credit markets are healthier than they have been. I have a long history in the credit markets, and I've definitely seen areas, telecom, energy, healthcare. There's always been specific areas that have developed excesses that then ended up repricing the whole high yield market wider. But, we're not facing that right now. It's not saying that there couldn't be excesses that develop, but right now, everything points to another strong year in 2025 for credit.
So the trades are then, Joanne, credit and short duration. Is there anything, or short in duration, is there anything that could make you buy longer durated treasuries? Is there anything that could make it attractive in 2025?
I guess it would have to be an additional, significant backup in rates. Eventually at some point, it probably would make sense to go out longer in duration, especially if you had a longer term horizon for investing.
Joanne, when it comes to also in the credit market, with spreads so tight, where else are you seeing opportunities?
Well, so we see, our main focus for next year and what we're telling all of our clients are, number one, to buy credit, and number two, to stay short duration, and then finally to be tax aware in their investing. And what that means in fixed income is, there's a lot of different choices in fixed income. And sometimes it's, paying taxes on higher yielding investments is better than buying only tax exempt securities. So there's a lot of different areas, but it's about precision. It's about figuring out where you want to be in fixed income to, reduce your volatility and take advantage of the higher yields.
With yields still very high this year, though, do you think that the 60-40 portfolio will be making a comeback even stronger in 2025?
60% equity? Well, we think it should be 60% fixed income.
Okay, fair point. Let's talk about what you're expecting in terms of fixed income when it comes to the Treasury market and what we got out of the Fed in this final Fed meeting of the year. Jay Powell went from not assuming to many members of the FOMC actually assuming when it comes to Trump policy. At that point, then, as an investor, how do you decipher really how the Fed is incorporating all the incoming data that's coming at them?
There's always just so many uncertainties and things can change direction and with the information that they have. But now all information is pointing to that there could possibly be a reacceleration in inflation. It's certainly not continuing to come down towards that 2% target. It seems, definitely stickier. So I think that they have to adjust, so what they wanted to do last year in terms of multiple rate cuts doesn't look like they're going to be able to do that. It would not be good for financial markets if they did.
Jen, just to play a little bit of devil's advocate, because Jan Hatzius of Goldman Sachs came out with a call just before Christmas saying that they still expect 3 cuts from the Fed next year. And the reason is even because if we get tariffs and it comes with a little bit of inflation, it ultimately will result in weaker growth. That will be a problem for American growth. And what's more, it's not immediately clear that the labor market is completely healthier or is on the right trajectory either. So weak growth, a weaker labor market all means that they will get cuts. I just wonder what you think of that argument.
I just think that we don't necessarily see the current level of rates as restrictive. I mean, maybe if you continue to see rates back up even from here, yes, maybe they start to be, but they haven't been restrictive enough that they've really curtailed economic activity. And the labor markets, yes, there's been some softness, but they're not, falling off a cliff.
Joanne, thank you so much for your time this morning, and Happy New Year to you. Joanne Bianco of Bond Blocks. Let's get you an update on elsewhere stories we're watching this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. OpenAI's board is evaluating a plan to create a conventional money-making corporate arm alongside its nonprofit arm. The plan would turn the business into a public benefit corporation, meaning an entity free to pursue income, but with the goal of bettering society while retaining its nonprofit side. As part of the new structure, the nonprofit arm would hold shares in the money-making side. Meanwhile, the NBA pulled in its best holiday numbers in years on Christmas, and the NFL's Netflix debut also had an impressive showing. The NFL and Nielsen said 65 million viewers in the U.S. tuned in for at least 1 minute of one of the 2 NFL games, with the numbers peaking during Beyoncé's halftime performance, of course. And the NBA, which has struggled with TV audiences this year, achieved a 5-year high, averaging about 5.25 million viewers per game. And Kim Kardashian is no longer assisting in managing SKKY Partners, the private equity firm she co-founded back in 2022. In a security filing this week, the firm disclosed that Kardashian is no longer an executive officer. Its website now refers to her as a co-founder and senior operating advisor. She was previously listed as a managing partner. That's your Bloomberg Brief. Anne-Marie?
Thank you so much, Yahira, for all your work this morning. Danny, you track private equity. Has this firm made any big deals?
Okay, they bought one thing and one thing only, and that was part of the problem. And it was a luxury sauce company called Truff. So that was a problem for them. They also didn't raise nearly as much money as they had. I'm disappointed. Honestly, Anne-Marie, I thought it was a brilliant idea. Kim Kardashian, the savant of branding, didn't work out that well.
No, I didn't even know there was really this huge market for luxury sauce, but that's for another time. Danny, I know you have to go. Thank you so much for joining this morning. Merry Christmas and happy holidays and Happy New Year to you and your family. Up next, I'm going to still be here in the surveillance chair. Charles Lieberman of Advisors Capital Management will be joining me. We're going to discuss what else 2025. You're watching Bloomberg Surveillance. Good morning and welcome to the final Friday of 2024. This is how U.S. futures are shaping up ahead of the trading day. S&P 500 futures are down 0.4%. It's been a stellar run for 2024, but we are not getting that Santa Claus rally at the moment. But If you are on this trading desk, you are seeing a little bit of a pause. And as Danny said earlier, hats off to you for being in the office, those awkward days between Christmas and New Year's. Euro dollar this morning, touch firmer on the euro, sitting at 104.36. Although many are calling for parity next year, we've seen this absolute strength of the dollar. It's going to be one of the biggest dollar strength years we've seen since 2015. Right now, you have 10-year yield sitting below 4.6%, 4.59%. And New York crude this morning, $70.27. As I've been saying, U.S. futures trading lower, 10-year Treasury yield hovering near a 7-month high in this post-holiday trading. Chuck Lieberman of Advisors Capital Management writing this: the economic environment should be slightly positive for stocks and slightly negative for long-term bonds. Inflation prospects could easily worsen between tariffs and immigration policy, which would freeze monetary policy for some period, but longer-term rates would increase. We're hearing a lot of this, Chuck, and he joins us now. Chuck, thank you for spending your Friday morning with you. Happy holidays and New Year to you. So how are you thinking about the start of 2025, especially when policy, things like tariffs, immigration, are going to be so important to how the bond market trades?
Absolutely right, Anne-Marie. And I agree with you. Happy holidays to you as well. In my judgment, there are things to be nervous about. The possibility of tariffs will obviously increase prices for domestic consumers. That's potentially a really big negative when the Fed is trying very hard to bring inflation back to 2%. We also have concerns about the labor market. Job growth has been pretty good, but if immigration policy changes and President Trump actually removes people from the U.S. who came in illegally, but nonetheless are working, that's going to reduce our labor supply, which will drive up labor costs and also inflation. So there are reasons to be concerned about the prospects for inflation.
When it comes to inflation and tariffs, do you think this is a one-off hit, or could this be more pervasive?
Well, it initially is largely one-off, but it then tends to spread through the system. When you have a single auto contract, for example, that's negotiated between the UAW and the auto companies, it's a one-off thing and it pertains just to that industry. But nonetheless, everyone else is watching, everyone else is looking, and many other workers, labor unions get ideas that they can also push for 10% increases for 4 years in a row. That's a large increase. And so it does tend to transmit through the system.
So what do you make in terms of Fed policy with this kind of fiscal environment?
Well, I think the Fed wanted to get rates down while they could. And so they sort of rushed. They did 50 and then 25 and then 25. So they reduced rates by a full 100 basis points. But the market is looking at the economy. And the market is seeing that the economy is not weak. If you recall, a year ago, a lot of people were forecasting a recession. Obviously, that didn't happen. In fact, growth is well above potential. And it becomes even further above potential if we have fewer workers because we are getting illegal immigrants to leave the country. So no matter how you slice it, I think we've got inflation risk out there. The economy will probably grow more slowly. If you can't hire, you can't expand the economy as quickly. So we could have a very unusual combination of moderation in growth, yet upward pressure on inflation.
Do you think the Fed at the moment is restrictive?
No, very simply. What I look at is not overnight money, because if you look at overnight money relative to inflation, you can make a case that the funds rate is roughly on average where it belongs historically. You have a much, much tougher case when you look at the 10-year. At a 4.60 yield with inflation in the ballpark of, let's say, 2.60, I'm being a little bit generous here, you have the 10-year 200 basis points over inflation. Historically, it's been more like 250. So in my judgment, interest rates are not a bar to investment, to spending, and we see a very strong corporate issuance of debt in the marketplace because corporations see prevailing interest rates as attractive.
So when you put all of this together, potentially inflationary policies, you don't think the Fed is restrictive. Do you think we could see a 2025 when the Fed is actually not just on pause, but maybe raising interest rates?
Yes, but not in the early part of the year. In the early part of the year, the Fed is going to wait to see what happens with policy, with tariffs, with immigration policy. They'll look at the growth rate of the economy, and they will wait. They can afford to wait. There's no reason for them to rush ahead to lower rates anymore, and they have good reason to regret, shall we say, having lowered rates as much as they have. But I expect them to be on pause for a while, and then it depends very much on how things play out.
Chuck, thank you so much for your time this morning. Happy and healthy 2025 to you. Chuck Lieberman of Advisors Capital Management. I know you'll be focused on the policies as we are about what potentially 2025 has in store. This is what you need to focus on when it comes to the rest of the trading day, the final Friday of the year, and also the start of next year. So here we are counting down to the bell. We have Monday, pending home sales. Tuesday, U.S. bond market is going to be closing at 2 p.m. Eastern. Of course, it is New Year's Eve. Wednesday, New Year's Day, so the U.S. markets are closed. And Thursday, first round of U.S. jobless claims of the year. What we also get next week is policymakers coming back to Washington, D.C. A big fight already is going to be on Capitol Hill on whether or not Speaker Mike Johnson can remain intact, the speaker, and hold on to his gavel. On Monday, I will not be here, but Romaine Bostick, Danny Berger will be guiding you through the markets on Monday. It's yet another awkward day between the holidays and the new year, Christmas and New Year. If you know what day it is and if you are showing up to the office, hats off to you. Max Kettner of HSBC will be joining us, Cameron Dawson of New Edge Wealth, Dina DiLorenzo of Guggenheim Partners, and Patrick DeHaan of Gas Buddy. All of that is coming up next. That does it for me. There was no Santa Claus rally. Thank you so much for spending your Friday morning with me. And to the Surveillance regular viewers, thank you for welcoming me on the program this year. It's been a fantastic 2024, and see you in 2025. Good morning.